Okay, so how I'm gonna do the tutorials is like the midterm. I'm gonna do a little bit of the theory, and then we're gonna jump into problems for each chapters. Um, since it's only 2 hours and it's in person too, I'm doing my problems on Excel, but try to do them like on paper and practice, gaining speed that way. And on your cheat sheet, I would put like, what is the thing that you're always bugging when you're doing your problems? And I would put that on your cheat sheet. And maybe they changed the midterm too, but when I guess your midterm was more problem-based. My final was more problem-based. So my multiple choice questions were more like short calculations, and then there was long problems like what I'm gonna do as the questions in the problems here. So don't like put like theory stuff. Don't worry about that stuff. Like the theory they're going to test you on is stuff that shows up in problems already. And practice on past final, because the textbook problems, especially for like chapter 18, 19, 20, I don't find them really representative of what you're going to be tested on the final. And if you practice past finals, you're going to see that it's always the same type of problems that you're asked for. So like you repeat them and then you get used to like how to solve them. And yeah, I think that's all for my little like spiel on what to study. Good luck. It's tough that it's in person this semester. Like I cannot tell you, like I did it in like online, so it's different like study habits. So good luck. If you have questions until then, you can always message me on Messenger, or just post on the group chat. I'm kind of busy this week because it's busy season that started, and I also have my own exams next weekend, but I'll try my best to answer you like as quick as I can. So first chapters that we're going to cover is chapter 15 and 17, and they're kind of asked like together in the final because they kind of go hand in hand, and it's about shareholders equity and earnings per share. Shareholders equity is like your last bit of the balance sheet that you haven't covered yet in your accounting classes for ACCO310 or ACCO320. It's basically what the shareholders owe in the company. So you're going to see there the shares, you're going to see there the dividends, you're going to see there the retained earnings. So it's really based on the owners. And then earnings per share is just a calculation that you have to put in your statements under IFRS. And it just tells the common shareholders how much they could earn per share based on the results of the year for the company. So we're going to start with the shares. So, I mean, I guess a lot of you guys already know what a share is, but it's like a small part of ownership of a company. And there's different categories of shares. You're going to have common shares, and you're going to have preferred shares, and you can have multiple preferred shares in a company. And you're going to see, like, if you check like balance sheets of like big public company, there's going to be different types of shares. So you're going to have class A shares, which are normally common shares, and then class B, C, D, and the B, C, D are all going to have different features. And these features are normally why they're called preferred shares, because you're going to pay a little bit more to have these features on the shares. In a class, each shares is exactly equal and they represent the same amount of ownership. And depending on how many share a person owns, then that's going to represent their ownership in the company. So if a company has 1,000 shares and I owe 500 shares, then I have 50% of control of the company. Yeah. And then someone that has 10 shares will have 1% interest. Each share has basic rights. So this is for common shares, I think, if I remember, but it's to share, they're going to have, we see the same shares in profits and losses. So based on the net income, you're going to have the same amount of power for one share. So you get the right to vote for the board of directors, for example. And when the company goes bankrupt, then you're gonna have like a proportionate share of the assets of the company. And then there's a fourth like right, the preemptive right. And it's the right to share proportionally in any new issues of shares of the same class. Just so you know, it's not going to be tested, so I'll skip. But all the PowerPoints are already posted on the group, so you can just go after and maybe read them more. That's not right. Okay, so for common shares, they receive the last bit of dividends after the dividends are given to the preferred shareholders. They're not guaranteed dividends every year. And they're not guaranteed assets when the corporation is like goes bankrupt. They can vote. They have voting rights attached to the common shares, which preferred shareholders do not have. So there's normally like every like trimester or every year, there's going to be like every shareholders come together and they can take decision in the company. Normally, like if you have big company like Amazon, of course, you have like Jeff Bezos, who has like the majority of the shares. So he's the one that has the more voting power in the company, where if you only own like 100 shares, you're not going to have that much power. So not everyone participates, because sometimes like there's no point in participating, but you do have voting rights that are attached to common shares. If the company has only one type of shares, it's normally common shares. And I'm gonna skip through this. Then you have preferred shares. So preferred shares are special classes of shares that have rights attached to it that the shareholders are going to pay a little bit more to have. The type of rights that they can have is cumulative, which you're going to see is very frequently tested on. A cumulative preferred share means that if 1 year there's no dividends that are declared, and the year after there is dividends that are declared, the cumulative preferred share would get their dividends for the previous year that didn't get paid and this year. The previous year that wasn't paid is these type of dividends are called dividends in arrears. So if you have cumulative preferred shares and you declare dividends, you first have to calculate how much do I owe to my cumulative preferred shareholders for every year that I didn't pay dividends in the past. And then I calculate this year dividends, and then yeah. So you're always guaranteed that you're gonna get your dividends no matter what. You also have convertible preferred shares. So that allows the company or a holder to exchange the shares for common shares at predetermined ratios. So maybe I have 1 preferred shares and I can convert it into 8 common shares at a specific time. So the preferred shareholders has like the security of the preferred shares. So they know that they can always convert it into common shares, and they may gain from the appreciation of the company by converting preferred shares to common shares. So if the, I don't know, market value of the common shares go up like a lot, and they think it's a good thing, then they could convert their preferred shares into common shares and then gain like the market value of those common shares, if that made any sense. Sorry, it's 9/11 on a Sunday, so I might be rambling on, but I think it's clear what's written there. Callable, not really going to cover it because I think it was more tested on the midterm. Retractable, same thing. And then you have participating preferred shares. So if a preferred share is fully participating, that means that they get their dividends for the year. And then normally the rest of the dividends that was declared would go all to the common shareholder. But now if it's fully participating, the preferred share will get the same percentage of the residual dividends as the common shareholder. So let's say that there's 500,000 left in dividends to be distributed. Well, participating, I don't know, would get like 5% of their total book value, and then the common shareholder would get 5% of their total book value, and that would be like the same proportional amount of dividends for both. And then you have partially participating. So the preferred shares would get their dividends, then common shareholders would get, I don't know, like a 3% dividend, and then the rest would be given like proportionally on both their percentage. So it's just that common shareholders get like a certain amount fixed, and then after they get that amount, then the preferred shareholders and the common shareholders participate in the same percentage, and the rest of the dividends are left to be declared. We're going to do calculation on that. It's in the problems. And then for issuance of shares, there's 3 dates. Well, I guess that's the process, but okay, that's not where I'm at. Yeah. When you're going to issue shares, you're going to first get the shares that are authorized by the board of directors. Then the shares are offered for sale and contract sale shares are entered into. And then amounts to be received for the shares are collected and the shares are issued. So they're first authorized, then like people say, oh, I want to buy it, and then they buy it. So how you're going to account for it is that you're going to receive the cash, and then you're going to declare you're going to put in the market your common shares. If you have any issuance costs linked with you like putting the shares on the market, then that's going to be deducted from the amount that you're going to receive. You're not going to book an expense account because it is a capital transaction. So that just means that it needs to go in the balance sheet. So it's just going to go straight into the balance that they owe. So here it was 500 shares that were issued for cash at $10 per share. That means that the total amount that the company should have received is $5,000, but they had to pay $100 in issuance costs. So that's going to come and reduce their $5,000 to $4,900. For shares sold on a subscription basis, if it was not asked in your assignment, is going to be asked in your final. That happens when a new company is like a small company goes public, or when maybe a company offers shares to their employees. What happens is that someone is going to say, okay, I want to buy the shares, but I want to buy them later on. So you're only going to receive the full price of the share later on. And you might receive partial payments throughout the time of the contract. So how you're going to account for it is that when the contract is entered into, you're going to set up a subscription receivable and a common share subscribe for the amount on the contract. These two accounts go into your equity section of the balance sheet. Your subscription receivable doesn't go in your assets. So your net effect on equity is 0. It's just like to see that, okay, I'm going to receive cash later on, and I'm going to be issuing shares later on. If you receive an upfront payment, then that's going to reduce your subscription receivable in your equity, and that's going to increase your cash in your assets. And then your final payment, and when you receive your final payment, then you issue your common shares. So that's going to cancel your common share subscribed account, and then you're going to have common shares issued. If during the contract, one subscriber decides, okay, no, never mind, I don't want to get the shares anymore, I don't want to buy them. There's 3 ways to treat it, and it really depends on the situation and the problem, or what's written in the contract, like in real life. There's 2 things the company can do. They can return the amount that the subscriber has already paid for, if they paid anything, after deducting like some expenses, if they incurred any expenses. They can say like, okay, too bad for your money, I'm going to keep it. And if they keep it, they're going to treat it as a contributed surplus account. And they can also just issue fewer shares for the amount that the subscriber has already paid for. So if they pay $100, then they could issue like 3 shares. I don't know, instead of like 50 if they paid like I don't know, like $5,000. So this is the journal entry that you would do if they forfeit an amount. So you reduce your common share subscribed for the full amount. You reduce your subscription receivable for the amount that was left to be received. And then depending on the situation, you're going to credit one of these accounts for the amount that the company has already received. A company can go on the market and buy back their own shares. So that means that they're going on the market, they're buying their shares back for the amount of the fair market value. And so that means that you might have a difference between your book value of your shares and your market value of your shares. So that difference is going to be treated as you're going to allocate that amount on different account based on the accounts that you have in your equity section already in your problem. ASPE like sets out like really precisely like with what are the steps, which accounts do you attribute first your amounts. IFRS, there's not really the same like direction. It's more like use your judgment, but in your exam, it's always going to be based on the ASPE way. So even if the company is under IFRS, follow like these steps to treat the difference between the market value and the book value. Sorry, my cat is about to like jump on my desk and I don't want her to. Okay. So first, if the acquisition cost, so if the market value is greater than the book value, you're gonna attribute the market value, like the difference between the two in these accounts. So first, you're gonna debit your share capital for the book value. So you're gonna remove your shares at their book value. Then if you have any excess between, if your journal entry doesn't balance, the difference is going to first be allocated to the contributed surplus account. If there is one that was created for a repurchase of shares. So you're going to see in your problems, you're going to have like contributed surplus in like the little like paragraph, and you're going to want to check if there's a contributed surplus repurchase of shares. And if there is one, then you're going to put the excess in it. If there's no excess after you attribute it to the contributed surplus, to this contributed surplus account, then you're done with the transaction. But if there's still any excess left, then you're going to put it into another contributed surplus account, but that is for the same class of shares. So if you have, I don't know, contributed surplus, just like common shares, I don't know, then that's going to go in it. If you don't have one, or if there's still any excess after you allocate to that account, then you're going to put the rest in return earning as a debit. So you're reducing your return earnings. In the reverse, if your book value is greater than your fair market value, you're first going to reduce your share capital account. And then you're going to create a contributed surplus repurchase of common shares account. And that account is going to be used if later on the company buys back the shares, and then it's like this situation. It's like the step 2 here. So here's just like an example of a journal entry. So ABD had issued 1,000 shares for 2,500,000. I assume it also had a contributed surplus stock option for the same shares for 4,000 and a contributed surplus for previous repurchases for 1,500. ABC buys back 200 shares for $38 each. So first, cash, they paid 200 shares times $38. So on the market, they paid $7,600. But the book value of the shares was 25,000 divided by 100, so it was $25 per shares. So that means that the book value of these shares was 200 shares times 25, 5,000. So I have an excess of about like 2,600, I think. So first I'm gonna go look, do I have a contributed surplus for repurchases of shares? And I do, and it's at 1,500. So I put that as a debit to remove it completely. I still have an excess, so I wanna look, okay, do I have a contributed surplus for the same shares? And I do. I have a contributed surplus stock option for the same shares for 4,000. And how you want to calculate this one is you want to calculate it proportionate based on the number of shares you have in your book and how many shares you're buying back. So you don't want to remove it completely from your books. You just want to remove the 200 shares portion from your book. So that's why I did 200 divided by 1,000. So that gives you 20%. So it's going to be 20% of 4,000 that I'm going to remove. And then if I have any left over, it's going to go as a plug in my return earnings. If I didn't have a contributed surplus options, then I would just put directly the difference in my return earnings. And same thing, if I didn't have a contributed surplus repurchases, I would just skip that step and go straight to contributed surplus options. For dividends, there's two types of dividends. It can be a return on capital, so it could be like a cash dividend, or it can be a return of capital. So that happens when a company goes bankrupt, so it's liquidating dividends. So dividends, they come and reduce the equity amount in a corporation because the equity is reduced, like it's not something you owe to the shareholders anymore. So you're going to reduce it. I see the equity account as like things that you owe to the shareholders. So if you're giving them dividends, then you don't owe them anymore. So it's going to come and reduce it. It's fine. So for cash dividends, you're going to have like 3 dates. You're going to have the declaration dates, you're going to have the record dates, and then you're going to have the payment date. On the date of declaration, that's when the board of directors votes and approve the dividends that are going to be issued for the year. And that's when you're going to record your dividends account and your amounts payable. Then you're going to have your record date. And that date, you're not doing any journal entry. It's more so like on that date, that's like the final date that like you're going to look at the shareholder list and it's final. So if someone buys a share the day after the record date, they're not going to get any dividends. It's really only the shareholders that owe shares on the record date that are going to get the dividend. And then the payment date is when you pay cash the shareholders for the dividends. So here's just an example of what I just said. So they declare the dates on June 10th. So you're going to record your dividends and dividends payable. At date of record, you're just looking at which shareholders are on record on June 24th. And all these shareholders are going to get the 900,000. But you're not recording anything. And then date of payments, you're removing your payable and crediting your cash to for the payment. Dividends in kinds is dividends that are paid in other assets than cash. So it could be, I don't know, like it could be, most of the time it's investments. Could be a building. I don't know. I don't think that happens, but it could be. How these are measured, it's the fair market value of the asset that is given up. So, and you're not creating any gain or loss. For stock dividends, so instead of having cash, instead of having another asset, you're getting more common shares, for example, of the company. So what happens is that they're issuing more shares, but they're not changing the book value of the shares. What I mean by that is if there's a 10% dividend, stock dividend, and I owe already 100 shares, now I'm gonna owe 110 shares. But the value of my 100 shares was like $200. My 110 shares will still, book value will still be $200. So it doesn't change the value, total value of my shares. It just changes the amount that I have of shares, and it will reduce your price per shares. The shareholders retain the same proportionate interest in the company. So if I owe like 10% of the company before the stock dividend, I'm still gonna owe 10% of the company after the stock dividend. How you're gonna record them? Again, it's an equity account, so it stays in equity. You're gonna record your dividends and your stock dividends distributable. The amount they're gonna put here is your ex-dividend rate, which I'm gonna cover in the problem, but it's basically the amount that the shares trade for after the declaration of the dividends. At the date of distribution, you're gonna remove your stock dividends distributable, and then you're gonna issue your common shares. Again, it just all goes through equity. So your distributable is not like in your liabilities, it's in equity. So when you're going to calculate your dividends for the year, the first dividends that you're going to calculate is any dividends in arrears for cumulative preferred shares, if there's any. Then you're going to calculate the current year preferred shares dividends. Then you're going to calculate the common shares dividends. And if the preferred shares are participating, that's the last step. That's what you're going to calculate. First stock split, it's similar to stock dividends, but it's not the same. You're not going to create any journal entries. What happens is a company says, okay, we're going to do a 3-for-1 stock split. 3-for-1, they're going to triple the amount of shares that are on the market. So if I have 100 shares, now I have 300 shares. But again, doesn't change the proportionate ownership interest that I have in the company, because everyone tripled their shares. So everyone retained the same percentage. So you're not doing any journal entries because it doesn't change any dollar value. You're just going to put a memo notes in your financial statement saying that the number of shares has increased because of a 3-for-1 split. You can, I can say it, the company does it because sometimes they have like big retained earnings balance because they haven't declared shares, the dividends in a long time. So the market value of the shares is likely to increase because people are like, okay, well, they haven't declared dividends in a long time. So that means that when they're going to declare dividends, it's going to be a big amount. So I'm going to have a lot of dividends if I buy one share. And because of that, the price of the shares go up. So not everyone can buy them. So not because it's a high price. So they're going to want to do a stock split to reduce the price per share. And so more people are able to buy them. Okay, that was chapter 15. So chapter 15, the type of question you're going to get asked is to do journal entries, is to calculate the dividends. It is to, that's pretty much it. Yeah. So do journal entries and calculate dividends. It's normally linked with chapter 17 because chapter 17, you're still going to be talking about shares because you're talking about earnings per share. So the number of shares especially is linked with all your journal entries for the year. So normally they mix them together. So earnings per share, it is something that is only informative. By that, I mean that it is presented as a subsection in the income statement, in the financial statement. So you're not on a daily basis, like calculating what's the EPS. You're only going to calculate it when you're going to release your financial statements. It's just for common shareholders to know how much of a company's available income can be attributed to the share that they own. So that can help them to assess like how much potential dividend can I have in the futures for each shares that I own. So because common shareholders have the residual interest in the company, they can't say for sure like how much dividends they're gonna get. As like preferred shareholders normally, they kind of know because they have like a specific, okay, I'm gonna get a 7% dividend. My shares are cumulative. So I know that like for all these years, I'm gonna get 7% of the amount that's declared. For common shareholders, they don't really know. They can't assess it like reasonably. So the EPS is kind of a good way for them to kind of figure out a little bit more like how much can they potentially get from dividends. So how you're going to calculate it is you want to find the net income that is available for common shareholders. So that net income is you remove any preferred shares dividends because they're going to get paid first. If the preferred share dividends are non-cumulative and there's no dividends are declared for the years, then you just take your net income. But if the preferred shares are cumulative and there's no dividends are declared for the years, you're still going to want to remove that portion of dividends that is going to get paid in future years from your net income, because when it's going to get declared in like 2 years, that amount is going to get paid first. So common shareholders are never going to get that amount as the dividends. So there's two types of EPS. You have basic EPS and diluted EPS. Basic EPS, you look at the actual earnings and the actual number of common shares outstanding. So you're going to find your actual net income available for common shareholders, and then you're going to find your actual weighted average number of common shares, and you're done. For diluted EPS, it's like a what-if calculation because a company can have convertible financial instruments that can be converted into common shares. And if they are converted, that's going to impact the EPS. And that's going to impact like how much each shareholder can expect to gain from their shares. So you're going to take into account the possibility that the financial instruments might have a negative impact on the EPS. So you're going to want to calculate what's going to be the net income impact of each of my convertible securities and what's the number of shares impact of my convertible securities. And then you're going to find if these are dilutive. So that means that they reduce the EPS. And if they do, then you take them into consideration when calculating your diluted EPS. We're going to do a problem on this. I'm just saying words right now, but we're going to do our problems. And I think it's like clearer if we're doing it with numbers. Important thing, if there's a stock dividend or a stock split during the year, let's say like in June, you're going to want to restate all prior period balances of shares to reflect that stock or dividend or split. Because it's more for comparative, it's more to get a good to be able like to compare like apples with apples, because the total number of shares increased, but the percentage of ownership hasn't. So because of that, you want to like reflect that in your number of shares. Did I say it like better here? Okay. So this is clear. When you have a stock dividend or split, the ability for each share to generate earnings doesn't change because you have a stock dividend, because you still have like, it's just that one share is now 2 shares. So you just get 2 shares now. So you're going to need to update your prior year to reflect the new number of shares at year end. I feel like I'm not explaining this well. It's just to help with comparability with the next year in progress. It's just so you get to see, like, if there wasn't a stock split last year, and there's one this year, then last year you're gonna have less shares, but like, and you're calculating your EPS and it's gonna be greater, but it's not really. It's just to show, like, it's just to compare apples with apples. Like, it's just, yeah. I hope it's clear. I feel like it wasn't clear at all. Well, we're gonna just know that when there's a stock dividend or a stock split, you're gonna have to reflect that into prior balances of shares in your calculation. We're gonna do it a lot in the problem, so maybe that's gonna be a little bit clearer of what you need to do. Discontinued operations, probably in your assignment, probably not in your final. And yeah, diluted EPS, I covered it, but it's for call option, put options, warrants, convertible preferred shares, and convertible bonds that you're gonna get. That these are the securities that are included in the diluted EPS calculation. Okay, that we're gonna do. A security can be anti-dilutive, and by that, it means that instead of reducing your basic EPS, it's gonna increase it. And if that is the case, then you're not going to include it in the diluted EPS calculation because it has a positive impact. What you're trying to find with diluted EPS is what is the lowest EPS I can get if everything gets converted. So if it increases it, then it's not going to be the lowest EPS. So you want to remove it. And here's just like a summary of how you're going to calculate the income effect and share effect of all the financial securities. We're going to calculate them, but like I said, you can come back to the PowerPoint after to check it. And that's it for chapter 15 and 17. I'm going to do the problems now. Okay. So this is a really long question, and I don't think your question is going to be this long for your final, because before the final was 3 hours. But I think it's really good practice for your final. Kind of covers everything of both chapters. So M Funds Limited, which is IFRS compliant, reported the following balances as at December 31st, 2014. They have 7% per $100 convertible bonds issued at par. They have 3,000 call options, each entitled to purchase one common share. They have cumulative preferred shares. There's 36,000 convertible shares outstanding. Common shares, 112,500 shares issued and outstanding. They have a contributed surplus on repurchase of common shares, and they have a return earning balance of 1 million. The company also informed you details related to the following transaction during 2015, and then you have the journal and every transaction that happened in 2015. Additional information, the cumulative preferred shares had been issued several years ago when the company was incorporated. It carried a dividend rate of $2.10 per share, and as of January 1st, 2015, one preferred share could be converted into 2 common shares. The company reported earnings from operations of 1.8 million for 2015. There were no discontinued items to report in 2015. The bonds had been issued at par in 2012. No premium was charged for the conversion rights, and debt was credited for the full amount received. Each $100 bond was convertible into 8 common shares. So the first requirement is to prepare journal entries for items A, B, C, E, and F. After, we're going to have to determine the weighted average number of shares and then calculate the basic EPS. So A, B, Okay, A, B, C, E, F. Okay, so if we start with A, it says that on February 1st, 2015, the company declared and distributed a 20% stock dividend for its common shareholders. The shares were being traded in the market at $30 after the dividends. So remember when I said that when you have a stock dividend, the amount that you're going to put in your transaction is the ex-dividend rate. And that's the, well, it's given to us here is the price that the shares are being traded for in the market after the dividends. Would be traded for in the market after the dividend declaration. So they give it to us here, but they might not give it to you in your final. So there's two ways you can calculate it. The first way is to do your total common share capital. So it would be like the 2.8 million divided by the total number of shares outstanding after the stock dividends. So now it would be like, so it would be 2.8 divided by 112,000 times 1.2 because it's a 20% stock dividend. And then the second way to calculate it is the pre-dividend price, if it's given to you, divided by 1 plus the stock dividend percentage. So in this case, it would be 1.2. So that's the two way you can calculate it. If it's given to you like it is here, it's really based, like, just be careful when you read because sometimes it can be tricky. Just don't bother calculating it, just use it straight away. But if it's not given to you, calculate it. Your journal entry is going to be common shares distributable to common shares. And it is going to be 112,500 shares times 1.2. No, sorry, times 0.2 times $30. Put it here. Oh my God, my mouse is like not cooperating today. Okay, so that's for A. So that means that now I have the number of shares outstanding is now 112,500 times 1.2. I now have 135,000 shares on the market. For B, on March 1st, 2015, it acquired 18,000 of its own common shares in the market at $30 per share and retired them on the same day. So they're IFRS compliant, but we're going to use the same thing that ASP would do. So first, you find the book value of the shares that they are buying. Two, if there's a contributed surplus repurchase account, you use it. Three, if there is a contributed surplus account for the same type of shares, you use it. And then four, if there's still an excess, you debit your retained earnings account. So in this problem, I'm gonna have, well, I have my book value of the shares, so that's gonna be easy to find. I have a contributed surplus on repurchase of common shares account, so I'm gonna use it. But I don't have step 3 here. I don't have another contributed surplus account for the same type of shares. So I'm gonna skip this one, and if there's any excess, it's gonna go straight into retained earnings. So my transactions and the common shares. So this is based on your book value. So these are the common shares that you're removing from your books. And I'm gonna use my contributed surplus on repurchase of common shares. Then I'm going to have my return earnings, and then I'm going to have the cash amount that I paid. I always calculate cash amount first because I just find it easier to calculate. Cash amount is just the number of shares that you bought back times the market value of the shares, which is $30. So it's 15K shares times $30. For the common shares, I need to find the book value first. So to find the book value of the shares, it's your capital amount. So it's going to be the 2.8 million here, plus any addition in the year to your common share account. So it's plus the $675,000 that we added in February. So that gives us 3.5 million. And then the number of shares, we already found it here, is the 135,000. So the price per share, well, I guess book value per share is this divided by this. So it's $26.33. So here, the amount I'm going to put is 18,000 shares times the $26. So I still have an excess between the two, right? My debits are not equal to my credit. And the difference is of 66,000. So I'm going to go look at my contributed surplus account and see how much I have in there. And I have 31,200. So I'm going to put the full amount of the account here. And then I still have an excess. So I'm going to put the rest in my return earnings, and it's just a plug amount. So you can just do your credit minus your debits. So my return earnings will be debited by 34,800. Any questions until now? And also, like, just feel free to write in the chat or just speak up if I go too fast or if you have a question. Then for C, on April 1st, 2015, the company issued 17,500 common shares in exchange for plant and equipment assessed at 336,000. So the company gained a PP&E asset in exchange for issuing shares. You're always going to take the fair market value of the assets. So here it's given to us, it's 336,000. So that's what I'm going to plug here. For D, there was no journal entry asked for, but we're going to be using it. We're going to be using it later on, so I'm just going to read it. On May 1st, 2015, 40% of the stock option holders exercised their options when the market price of the common shares was $31. So we don't have to do it, so don't waste your time because it was already the 135 shares here. I calculated it in A. So what I did in A is I took the balance that I had at January 1st. And then the first transaction was a 20% stock dividend. So that increased the number of shares by 20%. So I did my balance at January 1st times 1.2 to reflect the increase of 20. And that gives me the 135,000. And then in B, I used it because there was no other transaction since then in the common shares account. So I could have, so that's why I used it. If there was another transaction after, I would have added that to my 135,000. No problem. So this transaction is not tested because I guess it was tested on your midterm. In E, It says that on May 15, 2015, the company declared a 3-for-1 stock split on common shares. The common shares were being traded at the adjusted market price of $32 per share after the stock dividend distribution. So it's a 3-for-1 stock split. If you remember, we're not doing any journal entry. There's just going to be a memo in the financial statement at the end of the year. There's no journal entry because it's just increasing the amount of shares, but it's not changing the total value of the shares, so you don't have to book a journal entry. And then F, on August 1st, 2015, the company issued share certificates for 3,708 common shares to subscribers who had applied to an earlier share subscription issue. These subscribers had paid for the shares they had subscribed at $34 per share. So here the contract was already entered into, they're just issuing the shares. So that means that you already had set up in the past a common shares subscribed account. And now you're issuing the shares, so we're going to credit your shares. And the amount is going to be, they're not telling us that they did payments before, so we're going to assume that the payment, well, I guess it doesn't impact that journal entry. So it's just going to be the 3,708 common shares times the price on the contract, which is $34. And that's it for number 1. For number 2, question 2, we have to determine the weighted average number of shares for basic EPS for 2015. So how I like to set it up, and I think that's how it's showed in class, but I guess it's changed a lot since I took the class, so I don't know. Okay. So number of shares. I like to do a little table, and then in the table, I'm gonna put all the transactions affecting the number of shares during the year. So first, on January 1st, 2015, I had 112,500 shares. That's the first column that I'm going to be filling up. I'm going to do the time column at the end. So that's the number of times during the year that the shares were at 112,500. Split div is going to be filled out when I'm doing the number of shares. And if there was a stock dividend or a stock split, then I'm going to reflect it in this column. And then at the end, I can calculate my weighted average common shares. First, January 1st, I had 112,000. Then my first transaction impacting my number of shares was on February 1st, 2015. And there was a stock dividend of 20%. So that means that my number of shares increased by 20%. So I'm going to take my previous balance and do times 1.2, 135,000. Because it was a stock dividend, and remember my poor explication of reflecting it in your basic EPS. So I need to put my multiplicator of 1.2 into my balance at January 1st. So at the end, this amount is also going to represent the stock dividend. And also, if there's like a comparative year, so if the financial statements also have 2014, then my 2014 EPS is also going to reflect the 1.2 multiplicator here. So all past amounts of EPS needs to be restated to take into account the stock dividend and the stock split that's going to happen later on. My third transaction is on March 1st, 2015. And the company acquired 18,000 of its own common shares. So that means that it reduced the number of shares that they had by 18,000. So I'm going to take my previous balance minus 18,000. Then on April 1st, 2015, the company issued 17,500 common shares. So I'm going to increase my number of shares by 17,500. Then on May 1st, 40% of the stock option holders exercised their options when the market price of the common shares was $31. So that means that stock option holders, the call options, they 40% of them purchased one common shares. But you have to be careful with that because they were able to buy one common shares on January 1st, but there was a stock dividend since then. So now one common share is now worth 1.2 common shares. So you're going to want to reflect the stock dividend also in the calculation of the number of the number of common shares that were issued because of the call options. So that means that I'm taking my previous balance and I'm going to do 3,000 because that's the number of call options times 40% because that's the number of the holders that exercise their options times 1 share because they were entitled to purchase 1 common shares, and then times 1.2 to reflect the stock dividends. So here it's going to be 3,000 times 0.4 times 1 times 4.2. So you always, so stock dividend, stock split, you want to reflect it also for your call options when they, or convertible shares also. Like if you have preferred shares that are convertible into common shares on January 1st, which we have here, when they're going to be converted, you want to reflect the stock dividend or the stock split. If these were already outstanding before the stock split or stock dividend happened. If there was no call options on January 1st and there was only went into the contract in December 2015, then we don't care. Then it will be 1 common share because the stock split already happened, the stock dividend already happened, so we don't need to reflect it into the common share because the 1 common shares already reflect that amount. I hope it was clear, but just always take it into consideration if you have it in your past balances. On May 15, 2015, or 5th transaction, the company declared a 3-for-1 stock split on common shares. So what happened is the number of shares tripled. So I'm going to take my previous balance and do times 3. Remember, we want to reflect the stock split and stock dividends on all previous balances of shares. So I'm going to do times 3 here, times 3 here, times 3 here, times 3 here, and here I'm also going to do times 3. So here you have the effect of the stock dividend and the stock split because it they both happened after January 1st. On August 1st, 2015, the company issued share certificates for 3,708 common shares. So you increase the number of shares by 3,000. I'm going to do this plus 3,708. And then on October 1st, 2015, 20% of the bondholders submitted their bonds to the company for conversion into common shares. So we also want to reflect here, we want to reflect the stock split and the stock dividend because it happened, the conversion happened after both. So how I'm going to do this, I'm going to take my previous balance plus I want to calculate the number of bonds in total that I have. So in total, I have 250,000 divided by $100. I guess 2,500, but I'm just gonna put it as a formula. There's only 20% of the bondholders that converted their shares, so I'm gonna do times 20%. each convertible bond is convertible into 8 common shares. It's written into our additional information here. So I'm going to do times 8. And then I want to reflect my stock split and my stock dividend. So I'm going to do times 1.2 for my stock dividends, times 3 for my stock split. So here we found the number of bonds. That's this amount of the calculation. We found the number of bondholders that converted their bonds into common shares, so that's 20%. We found how many shares can each bond can be converted into, and that's 8 shares. And then we reflected our stock dividend and our stock split. And then there was no other transaction impacting the number of shares. So I can move on to the time column. And here you're just finding like how long during the year was the balance of shares 112,500. So here, for example, on January 1st to February 1st, so that means it's 1 month. So I'm going to do 1 divided by 12. February 1st to March 1st is also 1 month. So 1 divided by 12. March 1st to April 1st is also 1 month. April 1st to May 1st is 1 month. May 1st to May 15 is half a month. So I'm going to do 0.5 divided by 12. May 15 to August 1st is 0.5 for May 15 to May 30th. And then June, July. So it's 2.5 months. And then August 1st till October is October, September, so that's 2 months. And October 1st until December 31st is October, November, December, so it's 3 months. And a way, if you want to like verify if you calculate the right amount of time, is if you add all of your time up, it should equal 1 for 1 year. And then once that is done, you can finally calculate your weighted average common shares. So what you do is your number of shares times the time times any split div. Oops. And you're going to copy this. And then here, I'm just going to do this time, the number of shares times the time, because if I do times this too, it's going to give us 0 because there's nothing. Okay. And then you sum all of these amounts up, and that's going to give you your weighted average number of common shares for the year. So on average, there was 407,000 shares outstanding during the year, on average. That's for 2, and then for 3, they're asking us to determine the basic earning per shares for 2015. So 3. So the calculation is the net income available for common shareholders divided by our WACs. To find my net income, I'm going to take the net income for the year, the overall net income, and that was given to us, I think, in the additional information. Yeah, it was given to us in number 2, so it was 1.8 million. And then I want to remove my preferred shares dividends. You're only going to remove it if they're cumulative or if there was dividends declared during the year. In our case, there was no dividends declared during the year. It's telling us in H, but the preferred shares are cumulative. So I want to remove their amount of dividends that they're going to get in future years when the dividends are declared. Because the common shareholders are never going to touch this amount of the income. So we want to remove it. So the amount of dividend is, they carried a dividend rate of $2.10 per share. So it's going to be our 36,000. So that's the number of shares times $2.10. So that gives us the net income for common shareholders, and it is our 1.8 minus 75,000. So that gives us 1.7 million. Then we're going to take our weighted average common shares that we calculated earlier and find our basic EPS. We do our net income for common shareholders divided by our common shares, number of common shares, and that gives us a basic EPS of $4.35. And that's it for section A. But we also have section B. So for section B, they're going to ask us to identify the potential dilutive securities which could be included in the computation of diluted earnings per share, and then to calculate the diluted EPS for 2015. So we're just going to see which information that they're giving us for section B. You must still continue to use all the basic information contained above except where stated otherwise. Now, assume for this section only the following. Assume that none of the convertible bonds nor the convertible preferred shares were converted during 2015. Similarly, none of the call options were exercised during the year. The strike price for the call options, duly adjusted for dividends and split, was $9 per share. Further, assume that on January 1st, 2015, the company had also issued 3,300 put options to its directors as compensation for their service during 2014. Each option enabled the holder to sell one common share to the company at a strike price of $12, which is also similarly adjusted for dividends and split. All options were still outstanding on December 31st, 2015. Assume a 20% tax rate for 2015 and an average market price of $10, which reflects adjustments for dividends and split for the company's common shares during 2015. Regardless of your computation in section A above, assume that the weighted average number of shares for basic EPS was 407,400 shares. So that's nice. It's like a little okay, I know I computed it right in my question here, but don't panic if it's something similar and you didn't get the same amount. Just move on and do the next problem. And if you have time, come back to it, but it's like a race. So just take the number and move on. So we're going to calculate the diluted EPS. So first, we want to identify which of our securities are potentially dilutive. So in there's your put options, call options, warrants, convertible bonds, convertible preferred shares. We have 4 of those in this problem. So if we remember, if we look up here, we had convertible bonds, we had call options, and we had convertible preferred shares. They're adding us a put option in section B here. The difference between a call option and a put option is call option is you're buying the shares at a lower rate than the market, and put option is you're selling the shares at a higher rate than the market. And also they're telling us that none of the transactions here for our call options, convertible bonds, or convertible preferred shares matter. So we're just going to take the balances that we have at January 1st. So I'm just going to put here what we have. We have a call option, we have a put option, we have convertible bonds, and convertible preferred shares, just so I don't forget that we have all 4 to do. How I like to do it is I set up a little table, and in that table, I'm going to calculate the net income effect, I'm going to calculate the share effect, and the incremental EPS of each of these options. When I've done that, after that, I'm going to rank them. And how you're ranking them is basically from the smallest EPS to the largest EPS. but you're doing that at the end. So I'm going to show you at the end. So first you have your net income effect. You have your share effect. You have your incremental EPS, and then you have your rank. So for my first financial security, I have call option. For call options, what you're trying to look for is how many more shares was I able to buy because of the call option than if I went on the market with the same amount of dollar and bought them at the market price. For call options, it's solely a share effect. You don't have any income effects because it doesn't impact your net income. It only impacts the number of shares that you're buying. So your incremental EPS is always going to be zero. They're the most dilutive financial security. The call option and put options, it's the same like logic. So your incremental EPS is always zero. So here, what you're trying to do is how many more shares, many more shares was I able to buy because of my option and if I went on the market. So first you want to find out like the total amount of money that they would pay if all the call options were exercised. So we're going to find first the total amount of shares that are going to be purchased with the call options. So here they said that there's 3,000 call options and each call option is entitled to purchase 1 common shares. But remember, there was a stock dividend and a stock split during the year. So you want to reflect that in your calculation also, because they didn't say that the stock option and stock dividend didn't happen. So you want to reflect it in your amount of shares. So we're going to do 3,000 times 1 for 1 shares times 1.2 times 3. So if on December 31st, all call options holder decided to use their call options, then there would be 10,800 shares that would be bought. And the total amount paid, if you're 10,800 times the strike price, which is given here, the strike price for the call options was $9 per share. So they bought all these shares at $9. $9 strike price. Then, yes, Jonathan?
When does strike price and the market price like change due to the stock dividend or something, or?
Yes, it would, but they say here that the price was adjusted for dividends and split. So I don't have to worry about that. And I mean, this is the only problem that I see, that there's a lot of dividends and split and that it's taken into consideration. But I think that you're not going to have to calculate it because this is more like 308 stuff. It's not for this class. It's too advanced.
Okay, thank you.
No problem. So now you want to see if I went on the market with $97,200, how many shares could I buy? Because the market price is not going to be $9. It should be higher. And they're telling us here that the average market price for 2015 was $10. So it is higher. So how many shares can they buy on the market with the same total amount of money? And here, all you're going to do is your total amount paid divided by your $10 market rate. So that means that the number of shares that they could have bought on the market with the same amount of money would be 9,720 shares. So that means that because of the call options, they were able to buy 1,080 more shares than if they went on the market. Yeah, my explanations are, okay. So this here is your share effect. Because when you're calculating the diluted EPS, you want to see what's the impact of my call option that is different than if someone just buys them on the market. And my impact in this case is that if the call options are exercised, there's 1,080 more shares that would be issued than someone that would have just bought it on the market. So my share effect is the 1,080. So that's for the call option. Then you calculate your incremental EPS, but it's 0 because, oh my God, I'm sorry, my mouse is like crazy. I have to stop using my mouse. Okay, so my incremental EPS is 0 because 0 divided by a number is 0. And then I'm going to do for my put options. So put options is not how many more shares can I buy, it's how many more shares can I sell because I'm selling them at a lower price than the market. So similar logic to what we just calculated. So how many more shares am I able to sell than if I sold them using the market rate? So first we want to see how many shares can they sell. Here, all the information is in section B number 2. So we know that it's on January 1st, 2015 that they issued the put options. So we're going to have to take into consideration our stock split and dividend. And they issued 3,300 put option. And each option enabled the holder to sell 1 common share to the company at a strike price of $12. So, yeah. Okay. So how many shares can they sell? You're going to do the 3,300 put options times they're all able to, they enable the holder to sell 1 common share. So you're going to do times 1. And then you're going to reflect the stock dividend and stock split. So you're going to do times 1.2 and times 3. So that gives us 11,880 shares. So here I did 3,300 times 1 times 1.2 times 3. Total amount received with the option is the number of shares times the strike price of $12. And if they went on the market, with the same amount of money and a market rate of $10, I think my explanation is not right. I'm always getting confused with put options. Trying to like figure out the explanation. Put options is selling. Well, let me Google what is a put option because what is a put option? Okay, so a put option holder, they're able to sell the shares at a higher rate than the market rate. So that gives them a profit. And because they're selling them at a higher rate, they're going to be selling less shares, but each shares are worth more money. So they're getting more money. If you went on the market and you wanted to have the same amount of money after you sell them, you will be selling more shares. So you want to see how many less shares was I able to sell to get the same amount of money than if I went on the market, because it's like less effort, you know, you didn't have to like find more shareholders to buy them from. So here it's more, but here it's going to be less. So here they sold 11,880 shares, and their total revenue was 142,560. The market price of the shares is $10. So if they went on the market and wanted the same amount of revenue, they would have needed to sell 14,000 shares. So that means that because of the put option, they only had to sell 11,000 shares. So that's a difference of 2,376 shares. So that's going to be your share effect in your calculation for diluted EPS. Your net income effect is again 0 because it doesn't impact your net income. So your incremental EPS is also going to be 0. So when you're doing call options, put options, and also warrants, which is not here, but it's the same logic, you want to see the difference between the number of shares with your options versus the number of shares if you went on the market with the same total amount of money. And then the difference between the number of shares is your share effect. Then you have convertible bonds. For convertible bonds, you know, with bonds, if you remember from your midterm, you're paying interest. You're paying an interest expense at every period. So if the bonds are converted, you don't need to pay that interest expense anymore. So your net income effect is the amount of interest expense that is going to not be paid for the year after tax, because your net income is after tax. And the share effect is the increase of number of common shares because of the conversion of all the bonds. So income effect is expense after tax avoided, and share effect is the number of shares issued. So how to calculate your net income effect is how you're calculating your interest expense. So first I'm gonna remove my tax from it. So it's gonna be 1 minus the tax rate of 20%, that is here, times 7%, because it's the interest rate, times the book value of 250,000, sorry. So that gives me a net income effect of 14,000. So I did 80%, I did 1 minus 20% times 7% times 250,000. And then my share effect, where I'm going to find the number of bonds. So it's the 250,000 divided by $100. So that's my number of bonds. And each bond can be converted into 8 shares. So that means that, oh, and then you have to take into account your stock dividend and stock split, so times 1.2 times 3. So that gives me a share effect of 72,000. Here I did, yeah, Jonathan?
If they were issued like in middle of the year, would you have to prorate both of these amount or?
For the convertible, if the convertible bonds were converted or if the stock dividend and stock split
I'm
were.
talking about the convertible bond were issued like not in the beginning of the year, but in the middle. Would you have to prorate both amounts too, or?
No, because what you're trying to find here is if all my convertible bonds were converted into common shares. So it doesn't matter, the time period doesn't really matter. You would have, you're right though, you would have to prorate for your interest expense avoided because it would only be calculated on half the year instead of the full year. But the share effect will be the full amount of shares that are converted.
Okay, thank you.
No problem. So then here we can find our incremental EPS. So it is just my net income effect divided by my share effect. So that gives me an incremental EPS of 19 cents. So see here, my basic EPS was $4.35. And here it's 19 cents. So it's a big diminution. So it's very dilutive, but not as much as like 0, but it is dilutive because it's lower than my basic EPS. And then finally, I have my convertible preferred shares. And here it's the same like logic as my convertible bond. My share effect is the number of shares issued. But for my income effect is the, preferred shares have dividends. So you want to find what's the dividends that I don't have to pay to the preferred shareholders anymore. So it's the preferred shareholder dividends that are avoided. So here it's just the amount of dividend that we found earlier, which was 75,600. So what we did is our 36,000 shares times the rate of dividends, which was $2.10. And then my share effect, it's each shares are convertible into 2 common shares. So it's going to be 36,000 times 2 times my 1.2 times 3. So that gives me 259,200. And here my incremental EPS is net income divided by shares is 0.29 cents. Now I want to rank them. So no problem, Jonathan, the recording is going to be posted on today on the group. So also, I know there's a lot of tutorials today, so because this one is recorded, like feel free to leave. I'm not taking it personally, like it's okay. And you can just ask me questions throughout the week when you're listening to it. So you want to rank them from most dilutive to less dilutive. The most dilutive is going to be the ones that have the lowest incremental EPS. So in our case, our rank 1 would be our call option and our put options because they're at 0. Then we want to find the second lowest, which was our convertible bonds. And then finally, our convertible preferred shares, because this is the highest incremental EPS. Just note that all my incremental EPS here are lower than my basic EPS. If, for example, my convertible preferred shares, this is just hypothetical and just so you know if it happens during your exam or when you're practicing. If here, it would have given me 5, right? A incremental EPS of 5. Then, since it's higher than my basic EPS, if I added it to my diluted EPS, it would actually increase my diluted EPS. I don't want that. I want to find my lowest EPS that is possible. So this security is called anti-dilutive, and it's not included in the diluted EPS calculation. So I would do all of this and just not included. I wouldn't rank it. I would put like nothing here. Once you've found all of these, you can finally calculate your diluted EPS for 2015. So right, they're asking us for, yeah. So how I do it is I'm gonna put my net income effect, I'm gonna put my share effect, and I'm gonna put my EPS here. So first, I'm gonna use my basic EPS. So my net income effect for the basic EPS was the 1.7 million. I'm not taking this one here because we have to remove our preferred share dividend. So I'm taking the one that's available for common shareholders. And my share effect was the 400, well, they're giving it to a third. It's the 407,000 shares. So basic EPS, right? We calculated already, so that's fine. Then after, I want to add all my rank 1 securities. So for my rank 1, I'm going to add in my net income effect, the net income effect of the call option and the net income effect of the put option. And I want to add their share effects too. So their share effect was 1,080 and 2,376. So my rank 1 EPS would be, I add all of these together. And then I divide my net income effect by my share effect. So that gives me a rank 1 EPS of 4.31. So you see, it's lower than my basic EPS. So it means that it is dilutive. It is reducing my EPS. So I can continue to my rank 2. My rank 2 income effect was 14,000 and share effect was 72,000. So my rank 2 EPS, oops, I'm gonna do the subtotal here. So you always take into account your previous EPS that you calculated. So my rank 2 EPS is income divided by shares, so it's 3.69. So again, it is lower than my previous rank, so I'm going to continue to dilute it. If here it was 5 instead of 3.69, then it would be dilutive, and my diluted EPS would be my previous one of 4.31. So you always want to be on the lookout. It needs to be decreasing each time. As soon as it increases, you stop and you take your previous EPS. Then 4, you have the rank 3, which was our convertible preferred shares. And do the sum. And then here my rank 3 and potentially diluted EPS is 2.5. Since it is lower than my previous EPS I calculated, this is going to be my final diluted EPS. I don't have any more securities to go. So this is what I'm going to put as a diluted EPS in my financial statements. This is it for chapter 15. No, it is not. We have section C. Okay, it is almost it for chapter 15 and 17. Here we're going to calculate the dividends, if there was dividends that were declared for the year. So the total dividends which the management would declare and the total amounts payable to each group of shareholders. They're telling us that for this section only, there were no transactions affecting share equity during 2015. Thus, on December 31st, 2015, the company reported the following. For our cumulative preferred shares, there was 36,000 outstanding for a total of $960,000. For common shares, we had 112,500 shares issued for a total of 2.8 million. And for retained earnings, it was 1.1 million. During the year, the company also reported earnings from operations of 1.8. The cumulative preferred shares, as stated above, could participate in dividends declared after the common shares received a minimum dividend of $3 per share. So they are not fully participating. There's they're only participating in excess of the $3 per share dividend. Participation in the excess dividends is based on the relative total capital contributed by each group. The company management wishes to declare dividends for 2015, such that each common share would be entitled to a dividend of $4 per share. Dividends were last declared in 2012. Okay, so I'm gonna put down the book values and the number of shares for the preferred shares and the common shares. So for the preferred shares, there was 36,000 shares for book values of 960. And they have a dividend of $2.1. Yeah, so their dividend rate is $2.1. Then for my common shares, I had 112,000 shares for a total of $2.880,000. They're gonna get a $3 dividend for sure. And then after that, they're getting one more dollar because the management wants to declare their dividends so that each common share would get $4 per share. So since they're already getting $3 per share, then we would do an excess of $1 per share. And that $1 is going to be given to the common shareholders, and then you're going to have to calculate the same percentage of dividends for the preferred shareholders. And then after that, you get your full amount of dividends. Yeah, okay. Am I still sharing my screen? Just like a yes in the chat. Okay, thanks. So here I'm going to set up my preferred shares, my common shares, and then my year here. My preferred shares are cumulative. So we're going to want to check if there's any dividends in arrears. So that means if there was any previous years where the dividends were not declared and paid for preferred shareholders, and we're going to calculate them first. They're telling us here that the dividends were last declared in 2012. So that means that 2013 and 2014 are in arrears. So we need to find out how much they owe the preferred shareholders for these 2 years. So the amount is the number of shares, preferred shares, times the dividend rate of $2.10. Okay. And it's the same for 2014. So that's my dividend scenarios. Then for 2015, for this year, we're going to calculate the dividends for the preferred shares, and it's the same amount. $75,600. Then we can finally calculate the $3 dividends for the common shareholders. I'm only calculating the $3 because the preferred shares are not fully participating. So what they said is that they want the preferred shares are going to be participating after the common shares get a $3 per share dividend. So I want to calculate my $3 per share dividend, and then after I can move on to the preferred shares and common shares with the participating percentage and everything. So $3 dividend. So it's going to be $3 times the number of shares. So that gives us a $3 dividends of $337,500. Then the common shareholders are going to get in total $4 dividend. So I want to calculate what is my $1 dividend after. So $1 times the number of common shares is 112,000. And then since the preferred shareholders are participating in the same rate as the common shareholder for any dividends that is given after the $3 dividend, we're gonna want to find the percentage of this amount of dividend on the total book value of the common shares, and then use that percentage times the book value of the preferred shareholders, and that's going to be the amount of dividends that we're giving for the preferred shareholders for the year. So my percentage of dividends for the 112,000 was 112 divided by the book value of the common shares of 2.8. So that's a percentage of around 4%. And then my preferred share dividends is going to be that percentage times the book value of 960,000. So that gives us a dividend in addition to the previous one of 37,500. So the total amount of dividends that the preferred shareholders are going to receive is 264,000, and the total amount that the common shareholders are going to receive is 450,000. So that means that the company for the year 2015 needs to declare in total $714,000 in dividends, so that each group gets like everything that's described in here. If like in your exam, they might give you first the amount of dividends that are declared, and then based on that, you have to figure out the dividends. So maybe like sometimes like your common shareholders might not get the full amount of dividends that they are entitled to. So I think there's good book problems on that if you want to practice it. Okay, we're done with chapter 15 and 17. Yay. Because we're going to be jumping into chapter 18, do you guys want to like 5-10 minutes break just to like air it out a little bit, and then we get through the other 3 chapters? Yeah. Okay, so I'm going to come back at 10:55. So take a 12-minute break. You guys see, oh, you don't see the right screen. Are you guys seeing my PowerPoint like fully on the screen? Oh yeah, okay, you should. Thank you. So for chapter 18, it's like the big chapter of this class, and it is a hard chapter conceptually to understand, especially if you haven't taken tax for a business. I think it's ACCO320, because I mean, it's kind of like out of nowhere, like what is going on with tax? Like, why is it so different than accounting? But I promise you, it is hard to understand, but once you understand, the problems are very, very easy. But it's just to get the understanding of like what's going on and what do I need to do. That's hard. So I tried my best to like resume it in a way that would make a little bit more sense if you've never taken ACCO320. So accounting for income taxes. When, like in past classes, when you would look at your tax expense and your income statement, how it would have been calculated is just your tax rate times your net income before tax. That's your tax expense, and then you find your net income. But in practice, that's not how it's done, because you're not finding the amount of tax that you're going to be paying on your net income. You're finding it on your tax declaration. So on your tax declaration, you're not using necessarily your accounting income. You're going to be using your taxable income, and there's differences between the two. Your accounting income is determined using GAAP, so IFRS or ASPE. It's your income. It's based on your income before tax on the income statement, and it's used to provide useful information to the users of financial statement. Whereas your taxable income is determined according to the Income Tax Act that you're covering in your tax classes, and it's found in the tax declaration of the company. It's the amount on which the income tax expense is going to be calculated, or your income tax payable, I guess, is going to be calculated. So because not everything in accounting is simple, and that's why we have jobs. It's to be able to put these into terms. There's differences between financial accounting and tax. Under financial accounting, what you've been used to is that you're looking at your transaction on an accrual basis. So if you received a paycheck, well, yeah, I guess like personally, if you receive a paycheck on January 5, 2021, for the work hours I did in December 2020, you would include the paycheck revenue if you're doing personal income statement in your 2020 income statement because you worked those hours in 2020 and not in 2021. Whereas in tax, you're looking at transaction on a cash basis. So under tax, your paycheck would be included in your taxable income in 2021 because you receive your cash in 2021. So just there, you have a difference between accounting and tax. But imagine that for like revenue. A lot of revenue is you book it when you haven't even received your cash. A lot of expenses, you book them even though you haven't paid them, and vice versa. Sometimes you pay something, but you haven't recorded it yet as an expense. It's in your prepaid account. So all of these differences create, all of these like points will create differences between your accounting income and your taxable income. And these differences are called temporary differences because eventually, like in 2-3 years, those differences cancel each other. Because let's say you would have accrued your revenue in 2020, but you receive your paycheck in 2021, so you put in your taxable declaration in 2021. Well, in 2022, it doesn't matter because your differences between your income in 2020 and 2021 would have been reversed. Like they cancel each other. So they're temporary. They eventually cancel each other. But you also have permanent differences, and permanent differences are expenses and revenues that you're gonna include into your accounting income, but they're not allowed under tax legislation. There's no like logic. Well, I guess there's logic, but I don't know the logic. You can ask the 440 tutor for the logic if there's any. But it's just stated in the Income Tax Act, these expenses are not deducted for tax purposes. Some of them that you might see in your problems, it's dividends from taxable Canadian corporations, life insurance for CEOs and top management, fines and penalties, golf and social club dues. Social club dues, I think like meal and entertainment expenses, I think it's only 50% that you can deduct for your taxable income. Expenses related to the earning of non-taxable revenue. So in your problems, what you want to look for, they're going to tell you this expense is not deductible under tax law, or this revenue cannot be included in taxable income. They're going to tell you like word for word that this cannot be included. Yeah, so this is just a resume of what I've said. And permanent differences, because they're not, you cannot deduct them or include them under tax law, they're never going to be reversed. That's why they're called permanent. For permanent differences, you're going to deduct or include them to get to your taxable income, but you're not going to be doing any journal entries because you're not going to have any future impact of these differences on your statements. So like I said, what you have to look for is non-deductible for tax purposes, non-taxable, or only a percentage is tax deductible. For revenues, I've cut out the examples from my slides because they take a lot of time, but we're going to do most of them in the problems. A big one that is going to come in all your problems is depreciation versus CCA. CCA is like the tax depreciation of your assets. They're not calculated the same ways. Depreciation is more under accounting, is more like up to the judgment. if you're using straight line basis, you're going to determine, okay, I think this asset is going to be useful for 20 years. I don't think I'm going to have any residual value. I'm going to divide my book, my cost divided by my life, useful life, and that's giving me my depreciation amount. Under CCA, is calculated using like categories. And if your asset fits into that category, you have to depreciate it using the rule of that category. So you're gonna have differences there. So some years your depreciation is gonna be higher, and some other years your CCA is gonna be higher. But at the end, when your asset is no longer in use, that could be in many, many years, those differences between depreciation and CCA will cancel each other. For revenues, like for example, like rent revenue, if I'm renting my house, and I'm asking for a prepayment of like 3 months, and I received it 3 months cash, I'm not going to include the full 3 months into my revenue right ahead. I'm only going to include them in my revenue when the month has actually passed. Whereas for tax, you're going to include the full 3 months into your revenue as soon as you receive the cash. So eventually, after the 3 months, then the difference between cash and accounting is going to cancel each other. But if your statements are issued like after the first month, you're going to have differences. And installment sales, subscription, warranties, I'm all looking at it in the problem, but it's the same logic. Whereas like you're going to have a difference between what you put in your books for accounting and what you've received cash or paid cash. And that difference is a temporary difference and needs to be accounted for because it's going to create future impact in your statements. Your current tax expense is the amount of tax that you're going to be paying for the year. So how you calculate it is you start from your accounting income and you want to get to your taxable income. To get to your taxable income, you're going to add or remove your permanent and temporary differences depending on if you want to remove them from your accounting income or add them to your accounting income. When it increases the taxable income, so when you're going to add them, you're going to be adding revenues that weren't included in your accounting income. So let's say cash that you receive in January, but it's for like you put it in your unearned revenue in your statements, or you're removing expenses that were included in your accounting income. For example, your depreciation expense, you're always going to remove it from your accounting income. And when it decreases the taxable income is when you're removing revenues that were included in your accounting income but shouldn't be in your taxable income, or you're adding expenses that weren't included in your accounting income but need to be included in your taxable income, like CCA. And when you do all of these increases and decreases, you get your taxable income. And based on your taxable income, you're going to do your tax rate, and that's going to be your current tax expense. The taxes payable method is only allowed under ASPE. And it's where you take your taxable income times your tax rate, and that gives you your income tax expense. So I guess should show the other method first, but with the other methods, you're going to be accounting for your current tax expense, but you're also going to be accounting for your future tax expense. So all your temporary differences have future impact, and you want to record them. In this case, under ASPE, under the taxes payable method, you're just recording your current tax expense. You're not taking into account the future impact in your statements. You're not, I can't say for sure, but I don't think you're going to be quizzed on it. You're going to have a question on it on your final. But I'm not a TA or the teacher, and it seemed like it changed a lot, so you never know. But normally that's like an easy calculation, whereas this approach is a little bit more complicated. So the deferred future income tax approach, that is allowed under IFRS and ASPE. It is the same method, it's just that they have different name and different accounts name, but it is the same logic. I will use the deferred method for most of my problems because it's just quicker to write, but just so you know, you can use also future income tax. Well, you use future income tax for ASPE and deferred for IFRS. So what's gonna happen is you're gonna get your current tax expense, like for the future, like for the current tax method for ASPE, but you're also gonna be accounting for your future income tax expenses. So if I have a difference between my accounting and taxable income, that difference, I want to account for it in my statements, and I'm going to account for it on my balance sheet as an asset or a liability based on if I'm going to be paying more taxes in the future, that's going to be a liability, or if I'm going to be paying less taxes in the future, that's an asset. And that's also going to be reflected in your income statement under your current tax expense. So the goal of this approach is that your deferred tax expense, so your future impact of your temporary differences, plus your current tax expense, is equal to the tax rate times your accounting income less permanent differences. That's not the case under the taxes payable method since we don't have this account here. So you have an asset if the differences cause the company to pay less taxes in the future. So my taxable income right now is higher than my accounting income. So I'm paying more taxes now, but in the future, when these differences are going to be reversed, I'm going to be paying less taxes because my taxable income, when I'm going to be reversing these differences, my taxable income will become lower than my accounting income. But that's in the future. Right now, I'm paying more taxes because in the future, I'm going to be paying less taxes when the differences reverse. We're going to have a liability if the differences cause the company to pay more taxes in the future. So right now, I'm paying less taxes. So my taxable income is greater than is less than my accounting income. So I'm paying less taxes. But in the future, when the differences reverse, the impact is that, well, I'm going to have more taxable income and more taxable income than accounting income, so I'm paying more taxes. So again, an asset, you're paying more taxes now, but when the differences are going to be reversed, you're going to be paying less taxes in the future. So it's an asset, it's a benefit, you're gaining from it. It's a liability when you're paying less taxes now, but in the future, when in reverse, you're going to have to be paying more taxes. So you're going to be owing more to the government. So it's a liability, it's a payable in the future. These, your assets and liability, and when you're going to be doing your statements, when you're going to be doing your balance sheet, you put them together a little bit like how you're going to be accounting for like sales tax. So whichever, if you have a lot of temporary differences, but you have more assets than liability, then you're just going to record an asset for the net amount of all your differences, and vice versa for liabilities. So it's only one line on your statement. If you want a rule of thumb for expenses, if the expense you recorded under accounting is less than what you actually paid, so when you're going to be reconciliating to get to your taxable income, you're going to be deducting more expense. So that means that in the future, you're going to be adding more expense, you're going to be paying more in the future. That creates a liability. So if you do your accounting expense minus what you actually paid and it is negative, it's a liability. If under accounting, you recorded more expense, but you paid less, you're paying more taxes now, but less in the future. So it's going to be an asset. So when your difference between the two is positive, it creates an asset. Revenue, it's the reverse. If the revenue you booked for accounting is greater than the cash you actually received, then it's going to be a liability because you're paying, because it's going to be, wait, revenue, listen, collected positive. No, I think it's, if I have more revenue now than what I collected, it's a positive, so it's going to be an asset. I mixed them up here. Hold on. Basically, the sum of your temporary differences, when you're going to add them all together, if it's positive, it's an asset. If it's negative, it's a liability when you're doing your reconciliation schedule. I'll get back to it when we're doing the problem because I think with numbers it's going to be easier to explain. If you have a change in tax rate, so let's say that year one, your tax rate is 25%, year two, it's 30% because there was a change in like tax laws. If it's going to impact your deferred tax accounts because you're going to want, when you're accounting for your deferred tax accounts, you're taking the sum of your temporary differences and times your tax rate. So if there's a change in tax rate, you want to reflect the future tax rate. So you want to record them at the new tax rate because in the future, you're going to be using that tax rate when you're reversing your differences. So if, so you're going to record the change in tax rate immediately into your account. So if the tax rate for 2022 changes in 2021, you're going to calculate your deferred tax accounts using the tax rate of 2022. So I'm in 2021. I have my tax rate differences, and I have two different tax rates. And I know that in 2022, my tax rate is going to be different than in 2021. I'm going to straight up record my deferred tax accounts using my temporary differences, using my 2022 tax rate because I already know what my future tax rate is. But if I'm in 2021, I don't know yet what's going to be my tax rate in future years. I'm just going to record it using my tax rate for 2021. In 2022, when I know my new tax rate, I'm going to record the increase or decrease, depending on what the tax rate change was, straight ahead into my deferred tax expense. So if there was a change in 5% in tax rate, I want an increase in 5% in tax rate. I want to increase my deferred tax accounts by 5% to reflect the new tax rate. I did an example here. So here, my sum of my temporary differences in 2021 was $10,000. My tax rate was 25% in 2021, and in 2022 it was 30%. So if my 2022 tax rate changes in 2021, I'm gonna book it straight ahead at 30%, my 2022 tax rate. But if in 2022 my tax rates, if my 22 tax rate changes in 2022, in 2021 I would have recorded 2,500, so I would have recorded at 25%. In 22, when the tax rate changes, what I'm going to do is I'm going to increase my deferred tax accounts by 5%. So here it would be my 10,000 sum of temporary differences times 30% minus 25%. And then under tax laws, if your taxable income is non-income, a loss for the year, so if it is negative, one, you're not going to be paying any taxes for the year, and the amount of taxable loss that you have, you can apply it to previous income. So if last year you had a positive income and you had to pay taxes, you can take this amount and carry it back and like get a reimbursement for the taxes you paid in previous years. And if you can carry it back up to 3 years. So any past 3 years, you can carry it back. Normally, you want to carry it back to the further year. So we're in 2022 right now. I have a loss in 2022. I'm going to want to report it in 2019 because next year I'm not going to be able to gain back the taxes that I paid. My oldest year is going to be 2020. So I always want to carry it back to the furthest year that I had an income. And then if you applied all the amount to your past 3 years and you still have a leftover of taxable loss, you can carry it forward up to 20 years. So if next year I have a taxable income where I have to pay taxes, I can apply my taxable loss from previous years on it and either not pay any taxes or get a partial break from taxes and only pay the taxes on the leftover after I apply my taxable loss. How you're going to be accounting for it. I said that already. Yeah, so if you carry it back, it's just that you're going to have a income tax receivable amount, and then the other entry, if I remember, is just like a deferred tax. I think it's like a deferred tax account. I have the journal entries for later, and if you carry it forward, you're gonna have to carry it to the amount that you think that you're gonna be able to use. So if you think you can only use 40% of your loss carry forward, then you're only gonna book in the year of the loss a 40% provision for future years. If you think you can use the full amount, then you're gonna book 100% of that amount. So it needs to be more likely than not that there will be sufficient future taxable income to set up the receivable. So that means that it's more likely than not that you're going to have profit in future years. So let's say like you're a startup, but you're not really a startup. You've been starting up for 10 years and you haven't made profit and it's not looking great in future years. And you don't think you're going to have a profit for the next 20 years, then you're not going to book your loss carry forward in your statements. You just really need to be sure that you're going to have a profit. Okay, that's it for the theory. I went through it quite quickly, but I find that it's easier to, you see my solution? It's easier to see when practicing. So we're gonna do, there's always two types of question for chapter 18. You're gonna have to reconciliate, well, 3 types, I guess. You're gonna have to reconciliate your accounting income to your taxable income. You're gonna have to do the journal entries with all your temporary differences and calculate your current tax expense. You're probably gonna have a change in tax rate question. And then you're gonna have a taxable loss question where you're gonna have to carry it backward and carry it forwards. In your textbook, I really don't like the solutions. You can practice on them because they're great. There's still problems on chapter 18, but they're not that good in a sense that they don't really prepare you for your final. So if you're able to practice on past final, that would be awesome. There should be some that are posted on Moodle. And if not, you can just look at my past tutorials from the last year, and all I did was past finals. So there's a lot of material there. For question 1, they're asking us to reconciliate the accounting income to taxable income and then to do the journal entries. So TFX, using IFRS, provided the following information about its first 3 years of operation. In its first year of operation, the company used installment sales to promote its products. The company reported $40,000 in installment sales gross margin for the period. It did not have any installment sales for the next 2 years. TFX cash collection pattern on the installment sales was 10%, 35%, and 55% in the first, second year, and third year, respectively. TFX received in its first year $65,000 in cash for its new subscription-based website. The subscription contract is valid for the next 3 years. The revenue is recognized equally during the 3 years. TFX uses straight-line amortization for book purposes and recorded $20,000 in each of the first 3 years as depreciation expense. For tax purposes, it recorded $27,000, $22,000, and $18,000 of CCA in each of the first 3 years, respectively. Life interest premiums of $5,000 on the insurance policy on the life of the CEO of TFX was paid by the company every year. This expense is non-deductible for tax purposes. TFX uses the allowance method to record bad debt expense for accounting purposes and recognize $4,500, $3,000, and $7,000 of bad debt expense in each of the 3 years. For tax purposes, it was permitted to deduct only the actual account receivables write-off, so the actual losses incurred. Accordingly, deductible amounts were $2,000, $0, and $7,500. You can remove the extra zero of bad debt expense in each of the first 2 years, respectively. In each year, TFX received $2,000 as a subsidy from the government for new companies. These are non-taxable subsidies. TFX estimated its warranty expense for the first 3 years as $6,000, $9,000, and $4,000 respectively. The actual cash payments on warranties for each year were $7,750, $8,200, and $5,000. FTX recorded a $25,000 contingent liability in year 2 for accounting purposes. This was disallowed for tax purposes, and it would have been deductible only when the liability is paid. In year 3, it paid $14,000 of this liability. FTX reported accounting income after tax of $65,000, $89,000, and $127,000 respectively in each of its first 3 years. Assume that FTX operates only in Canada and statutory tax rate in year 1 was 30%. However, during year 2, the government enacted a change in tax rate to 35% for year 2 and the following years. So they're giving us here all the permanent and temporary differences. They're also giving us the tax rate, and they're giving us the accounting income after tax. So how I'm going to set it up is I'm going to have my year 1, I'm going to have my year 2, and I'm going to have my year 3. And then I want, when you're reconciliating from your accounting income, you want to find your accounting income before taxes, because if you add back your tax expense for the year, because if you don't, you already have your tax expense that we're calculating at the end with your taxable income, so you're kind of deducting more expense than you need to. So my accounting income after tax is given in this column. And it is here. So my accounting income after tax was $65,000, $89,000, and $127,000. Oh my God. Okay. Okay. So what I want to find now is my accounting income before tax. So I have my tax rate, and my tax rate for year 1 was 30%. For year 2 is 35, and year 3 is 35. So to find my accounting income before tax, I have to divide my accounting income after tax by 1 minus my tax rate. Yeah. And if you want to double check yourself, you can do this times your tax rate. And then if you do this minus this, it should give you your accounting income after tax. Okay. So here I did, for example, for year 1, and it's 65K divided by 1 minus 30%. Okay, so now I have my accounting income before tax. So I can move on to my permanent differences. So my permanent differences is everything that is not allowed for deduction under tax laws. There was a few that were given here. We first had the life insurance premiums. Why they're not deductible is just that they're saying here, this expense is non-deductible for tax purposes. So we know right ahead it's not deductible, so I can remove it. It's a mix of both. It depends. It's really a toss of a coin. So maybe they're gonna be nice and give you before tax, but you just have to be careful when reading the question. So your life insurance premiums for the CEO, it was $5,000 every year. So every year they remove from their net income $5,000, but they shouldn't have done it. So since it reduced their income every year, we want to add it back. So we want to cancel its effect on our accounting income. So I'm going to put it as a positive because it was an expense. All right, so I'm putting it as a positive because in my accounting income, I removed it to get to my accounting income before tax. Like when you're doing your expenses, it's a debit, and a debit is a reduction in your income statement. The second one was government subsidy for new companies. So they received $2,000 every year from the government as a subsidy, but they're non-taxable subsidies. So you want to remove them from your accounting income. We're gonna assume that it was recorded as a revenue, as you have probably saw in ACCO, the one before this, 310. And what you're gonna see in CPA school is that it can also be recorded on your balance sheet subsidies, but we're gonna assume it was recorded in revenue. So your $2,000, they put it as other income in their income statement. So that increased your accounting income, right? Because you're adding more revenue. So you want to remove its effects, or you want to deduct it to get to your taxable income. So I'm going to put it as a negative because that revenue shouldn't have been included in your accounting income to get your taxable income. So when you have an expense that is not included, you add it back. And when you have a revenue that shouldn't have been included, you remove it, you deduct it. And then we also have the contingent liability that was disallowed for tax purposes. This one, like honestly, you could have put it also as a temporary difference because it's also reversed in year 3. But since it says that it was disallowed for tax purposes, I'm going to put it as a permanent difference. But if it's a question like this in your exam, they should make it clear, or just like not put the second sentence here. So they recorded a 25,000 contingent liability in year 2 for accounting purposes. So that means that if they recorded contingent liability, they also recorded a contingent expense. So they reduced their income by 25,000, but under tax, they're like, no, you cannot deduct it. You can only deduct it when you're actually paying it. So I'm gonna add back the 25,000 expense that I deducted in year 2. And under tax, they're saying that they can deduct it only when the amount is paid. So the amount is actually paid in year 3, and they only paid 14,000. So I'm going to deduct the 14,000. It's not included in my accounting income in year 3 because in year 2 they included their contingent liability. So in year 3, the accounting like journal entry wouldn't take into consideration anything in the income statement. It would just be a balance sheet transaction. And that's it for my permanent differences. So now I can find my income after my permanent differences. I'm just gonna do my accounting income before tax and take into consideration all my permanent differences. So here, no journal entry are required for all three. So I don't need to do anything. I don't know why my mouse can't. Then for temporary differences, there's a few. We're gonna do them one by one, and I'm gonna separate them so you can see the impact for each. And I'll do first the reconciliation, and then I'll do the journal entry when we get to your taxable income. So the first temporary differences is for the first little bullet point here, is that it says that in its first year of operation, the company used installment sales to promote its products. The company reported 40,000 in installment sales gross margin for the period. It did not have any installment sales for the next 2 years. TFX cash collection pattern on the installment sale was 10%, 35%, and 55% in the first year, second year, and third year. So what they're saying here is that in year one, for accounting purposes, they book a $40,000 in revenue, but they didn't collect the $40,000 cash. They collected only 10% of the 40,000 in year one, 10%, 35% in year two, and 55% in year three. So what do you want to do? Year one, you want to remove, I guess, 90% of the 40,000 because you didn't receive 90% cash. You only received $4,000. And then in year 2 and 3, you didn't report anything under accounting income, but you actually received cash, I guess, the rest of the 90%. So you want to include it in your taxable income. What it looks like, you're going to have your ACCO sales and your actual cash receipts. ACCO sales, what I like to do is I like to completely remove the effect. I don't want to mix myself up. I always remove the accounting effect completely. So in this case, my accounting effect is that I book 40,000 in revenue. So I want to remove the 40,000 revenue because it shouldn't have been included. And then in year 2 and 3, I have no accounting impact because I didn't record any revenue for this particular bullet point in year 2 and 3. Then I want to record, okay, what is my actual tax revenue? My actual tax revenue is the actual cash that I collected for each year. In year 1, I actually collected 10% of 40,000. So that I want to add it as the revenue for year 1. In year 2, I actually collected 35%. So that's what I want to add in my taxable income for the year. And in year 3, I actually received 55% of the cash amount. So I received 22,000. So my cash I receive, I want to include it in each year. I don't want to include the accrual amount that I put in my statement for accounting purposes. I just want to include the cash portion. Any question for this one? Then my second temporary difference, it's a temporary difference also because you see, if I add all my cash received, they amount to 40,000. So in year 4, I no longer have the difference between the two. So the complete impact has been reversed by the end of year 3 when I book my 22,000 as the taxable income. So that's why we say they're temporary, because in the future, eventually they're going to get reversed. For subscription sales, it's like the reverse of installment sales. It is that you receive cash up front, but you're only booking it later in your revenues. So TFX received in its first year $65,000 in cash for its new subscription-based website. The subscription contract is valid for the next 3 years. The revenue is recognized equally during the 3 years. So that means that under accounting, you take your 65,000 and record a third of it in the first year, a third of it in the second year, and a third of it in the third year. But for cash, for tax, you only receive cash during the first year. So you should only record your income during the first year. Then the other 2 years, like you didn't receive any cash for that. So we shouldn't have revenue for those 2 years for the subscription sales. So I'm first going to remove the accounting impact, and then I'm going to put my cash received for tax. So my accounting impact is I book a third of $65,000 in revenues for each year. So since I booked revenue, it's increasing my accounting income, and I want to remove its effect by deducting it to get to my taxable income. So I'm going to remove 65,000 divided by 3. And since it's the same amount for the 3 years, I'm just going to copy my formula. And then for tax, the actual amount of cash I received was 65,000 in year 1. So I'm going to add the full amount in year 1, and then year 2 and year 3, I have 0. So again, if I add like these 3 amounts, it adds to 65,000. So at the end of year 3, when I take into account the last like accounting sales and I'm removing, I have no more difference between my tax and accounting. So the temporary difference has been completely reversed and removed. So I have no more future impact. Then my third bullet point is that TFX uses straight line amortization for book purposes and recorded 20,000 in each of the first 3 years as depreciation expense. For tax purposes, it recorded 27, 22, and 18,000 of CCA in each of the first 3 years respectively. So you're going to want to remove your depreciation expense and then add your CCA. I guess add your depreciation expense and remove your CCA because we're looking at expenses. So depreciation and CCA. So I want to remove the impact of my depreciation from my income. When you're taking depreciation expense, it's reducing your income. So it's making it lower. So I want to add it back to cancel its effect and put back your income to as if like that transaction never happened. So I'm going to put it as a positive because I want to remove its effect from the income. So I book 20,000 every year. So I'm going to add back 20,000 every year because I booked an expense that reduced the income. I want to cancel the effect of that expense. So I want to add it back so it has no more impact on my income. And then for tax, the actual expense for tax that I should take is the CCA amount here, the 27,000, 22,000, and 18,000. So I'm going to reduce my income by 27,000, reduce it by 22,000, and reduce it by 18,000. So that's it for depreciation versus CCA. So I'm removing my accounting impact and I'm booking like the tax expense. Afterwards, I have my bad debt expense. So if you remember, in your accounts receivable, you have to like kind of calculate how much of the accounts receivable you think you're not going to be receiving. And that amount is going to be a reduction of your accounts receivable, but you're also going to book it as an expense. But it's not the actual amount that you haven't received. It's just like an estimation. So you want to remove the estimation and you want to book the actual amount of accounts that you haven't received for the years. The actual amounts could, like how you figure it out, like for tax, it's like one of your client went bankrupt. So maybe like because they went bankrupt, you're not going to actually receive the amount. So that's how you're finding it. But they're in this class, they're just going to be given to you. So I'm going to remove my bad debt expense. And I'm going to the actual write-offs. So again, because it's an expense, I reduced it to get to my accounting income. So I want to cancel its effect, and I want to add it back. So I'm going to add back 4,500, 3,000, and 7,000 for each year. And then I want to deduct the actual write-off for tax. So the actual write-offs were 2,000, 0, and 7,500. My next one is warranty. So they estimated the warranty expense for the first 3 years at 6,000, 9,000, and 4,000. The actual cash payments on warranties for each year were 7,750, 8,200, and 5,000. So I want to remove from my book the estimation, so the warranty expense, and I want to deduct to get to my taxable income the actual amount that you paid for the warranty for the year. So my warranty expense that they booked is 6,000 for year 1, 9,000 for year 2, and 4,000 for year 3. I'm canceling their effect on the income, and then I want to book the actual expense for tax. So the actual cash that they paid is 7,750, 8,200, and 5,000. And then we have no more temporary differences. So any question on like the logic behind like why I put a number as a negative, why I put a number as a positive? I'm gonna lose my voice soon, so I'm sorry if I sound like I smoked for like 25 years. Okay, so then we can find our taxable income. The taxable income, yeah, exactly. It's negative for warranties because that's the actual cash that they pay. So it's a reduction in their cash for the year. To get my taxable income, I'm gonna go from my income after permanent differences, and I'm gonna add all my temporary differences. And that gives me a taxable income of 96,000 for year 1, and then year 2 and 3 here. Then I can find my current tax expense. So my year 1 tax rate was 30%, 35% for year 2, 35% for year 3. So my current tax expense is your taxable income times your tax rate. And then you're done with the reconciliation of your accounting impact taxable income. I guess you can also just stop here. I'm calculated this because I need to do the journal entries after, but if they're just asking you to reconciliate, you can just stop at taxable income here. So now we're gonna want to do the journal entries for year 1 and 2 only. So the journal entries, what you want to record is your current tax expense for each year, and also the temporary differences for each year. For year 1, I'm first going to record my current tax expense, and basically current tax expense to income tax payable. So we're comfortable with this journal entry. It's nothing like crazy. So this is to record the tax expense for year 1. Okay, then I'm gonna be booking my temporary differences. I'm gonna be booking them one by one. So what I'm going to be doing 1, 2, 3, 4, 5 journal entries. And then at the end, I'm going to show you how you can just do it in one journal entry. But I would always do each individually for your exam, unless they're not asking you to prepare the journal entries. They're just asking you to find the balance for your balance sheet or your income statement. But if they're asking you all income tax related journal entries, do all the transaction. And if they're just asking you for the balance of the statement, then just calculate it the way I'm going to show you after. So first, for installment sales, what I'm going to book for year one. So if you remember, I said that if your taxable income is greater than your accounting income, you're paying more taxes this year, but in future years, when it's going to get reversed, you're going to be paying less taxes. So that's a DTA because your amount is positive. If your accounting income is less than your taxable income, you're paying less taxes this year, but more taxes in future years. So your sum of temporary differences here is negative, so it's going to be a liability. Okay, so a trip, if you don't want to remind yourself of like, okay, my taxable income is greater than my accounting income, so I'm paying more taxes this year. In future years, I'm going to be paying less taxes, so it's an asset. What all you can look at is sum your accounting and your tax temporary differences together. If the sum is negative, you're going to book a liability. If your sum is positive, you're going to be booking an asset. So if it's positive, it's a DTA. If it's negative, then it's a DTA. Okay, so in this case, for installment sales for year one, if I sum them together, it's minus 36,000. So that means I'm paying not a lot of taxes this year because of my differences, but in future years, when they get reversed, I'm going to be paying more taxes. So what I'm going to be booking here is going to be a deferred tax expense, and then you're going to be booking your deferred tax liability. The amount that you're going to be booking it for is the sum of your two amounts here times your future tax rate. Now here, technically, we know that our future tax rate is 35%, but in year one, when they actually booked their journal entries, they didn't know that it was going to change in year two. Like it only changed during year two. So put yourself in the situation, you're the accounting, well, I guess staff accounting, booking your deferred tax expenses. You don't know what your future tax rate is going to be, so you're going to book it at this year's tax rate. So I'm going to book it at 30%. If I'm a staff accountant and I already know that next year, I know that in year one, that in year two, my tax rate is going to be 35%, I'm already going to book them at 35%. But it's not the case here. We don't know yet that there's going to be a change in year two. So did I take the 35% by any chance? Oh, it would be great if you add both amounts to your transaction. So I add my accounting and tax impact and times my current tax rate, and that gives me a journal entry amount of 10,800. So here I did 4,000, 40,000 minus 4,000 times 3%. Then for my subscription sales, if I look here, if I add them together, my total is positive. So that's an asset. I'm paying more taxes this year. Next year, I'm going to be paying less taxes when they get reversed. So when you're booking an asset, a deferred tax asset, you're booking your DTA as a debit, and then you're gonna book a deferred tax benefit, which goes in your income statement. It's basically the reverse of an expense. So instead of reducing your income, it's increasing your income. And I'm gonna calculate the amount the same way I did for installment sales. So I'm gonna do the sum of my accounting and tax impact times my tax rate. Then for depreciation versus CCA, if I look, if I add them together, it's a negative amount. And I'm also in the first year of operation, so it's going to be a liability. Normally, for CCA and depreciation, if you're like doing the reconciliation for like future years, like for year 5, for example, you're always setting up at, well, most of the time, I'm not gonna say always, most of the time you're setting up a deferred tax liability because you're normally taking more CCA in the first years of the asset than depreciation. And then as time goes by, you're gonna be taking more depreciation and then less CCA. Because CCA is like a percentage instead of like the same amount every year. So normally the amount that you calculate with the percentage is reduced throughout the year. So your CC gets lower and lower each year, whereas your depreciation stays the same. So if you have like a problem and you see that your depreciation is higher than your, well, I guess lower, if like your impact is positive, so that means your depreciation is higher than your CCA, then you would be reversing your DTL. So you would be reducing your DTL instead of having an asset. Yeah. So here I'm setting up a DTL, so it's going to be the same account as here. And then the amount I'm going to book is going to be the sum of my accounting and tax times the tax rate. Then I have my bad debt expense. And for my bad debt expense, my impact is positive, so I'm going to book an asset. And to find it, I do the sum of my accounting and tax times my tax rate. Oops. I have to say, if you're writing this like by hand, there's not going to be that many like temporary differences. Well, I hope for you guys there's not going to be that many differences. And then the last one is warranty expense. So for my warranties, the impact is negative, so I'm going to put it as a liability. And the amount is going to be the sum of the two here times my tax rate. I booked all my temporary differences for the year. And so they're not asking you to like find a balance on your balance sheet, but I'm just gonna calculate it for you so I can show you like the one journal entry, like how it works. So on your balance sheet, what you would have is, I'm gonna put it as a negative when it's a liability and put it as a positive when it's an asset. So I'm just summing all my amounts together. So here it's the positive amount, so it's an asset, a DTA asset. So I would have $325 in my balance sheet assets. If you want to just do one journal entry, what you can do is you take the sum of all your temporary differences. So I go from my accounting cells all the way down to, well, I go from my installment sales all the way down to my warranties. I add them together times my tax rate, and I get the same amount. If it was negative, I would have gotten a DTL. So that's a quick way to figure out if you're going to have a liability or an asset. And then since it's an asset, I also have a benefit in my income statement. So only do this if they're not asking you for all the journal entries, and you just need to figure out what you need to put in your statements. Okay, so now I'm going to record my journal entry for year 2. In year 2, the first thing is that there was the change in tax rate. So I want to reflect that. Yeah, so how I did it is I took all my temporary differences, I summed them all together, times my tax rate of 30%. The amount that I get is positive, so I know it's an asset. If it was negative, it would have been a liability. And I got this one by basically taking all my amounts in my journal entries. If it was a liability, I put it as a minus, and if it was an asset, I put it as a positive. So if it's more assets, then the amount is positive, and if it's more liabilities, the amount is negative. For year 2, I first want to reflect the change in tax rate for the deferred tax asset that I have at the end of the year of year 1. So what I'm going to do is, since it's an increase in 5%, so it goes from 30% to 5%, I want to increase my DTA by 5%. So here I'm going to have DTA, deferred tax benefit, and I'm going to take this amount, the 325, times 5%, or you can also do times like 35% minus 30%. So I reflected the change in tax rate in my DTA balance from year 1. So that's done. Then I want to record my current tax expense and income tax payable for the year. So my current tax expense for year 2, we found it earlier, it was 55,000. 55,000. And then I can record all my different, all my temporary differences. So I'm going to record them one by one again, because I want you to understand how to find if it's a DTA or DTL. So first I have my installment sales. If I look at my year 2 installment sales, it's positive. So it is a DTA. You can put it as a DTA, or you can also put it as a reduction of DTL, because we booked it as a DTL in year 1. Since the two accounts like net each other when you're doing your balance sheet, it doesn't really matter if you decide to like debit your DTL or just do a DTA. It comes back the same, but it would make an impact if you're trying to find like for a specific like temporary difference, like how much left do I have to pay? Well, how much left do I have to reverse at the end of the year? So I'm going to do it as a reduction of liabilities, just to reflect that for my installment sales, the liability that I booked in year 1 is getting reduced with my adjustment of year 2. So what I'm going to book is going to be a debit to DTL and a deferred tax benefit. And the amount is going to be the sum of my 2 amounts here times my future tax rate, which is of 35%. For subscription sales, for the year, I have a negative impact. Last year, I booked an asset, so it's going to be a reduction in my asset. So I'm going to credit my asset. So here it's going to be a different tax expense and a DTA. Like I said, you can put a DTA here. It's fine. I just want to reflect the fact that the DTA that we booked in year 1 is getting reversed in year 2. So the amount I'm putting here is, again, just the sum of my 2 here times the tax rate. Then I have my depreciation versus DTA. Here it's again a liability, so I'm just going to increase my liability again. So I'm going to add together the 2 amounts times my tax rate. Then I have my bad debt expense. Bad debt expense, oops. If I add them together, it is a asset, and it was also an asset last year. So I'm going to just increase my asset in year 2. So I'm adding my 2 impact together times my tax rate. And then for my warranty, I booked a liability last year, and this year I have, it's a positive if I sum it, so it's a reduction in my liability of last year. So I'm going to reduce my liability by debiting it. And then we're done with section A. So any questions related to journal entries or how to reconcile, you can ask me. I'm gonna let you guys write it down. Okay. Don't hesitate if I'm going too fast and you have a question on something I already covered. All right, so last question for chapter 18. No, because what I did is basically in year 2, I already accounted for the change in tax rate of the temporary differences of year 1. So I increased my balance of year 1 of my deferred tax accounts by 5%. And then in year 2, I'm already taking my 35% as my tax rate. So there's no, since I'm not booking it at 30%, I don't have to account for the increase of 5%. If I already knew that next year my tax rate would be like 40%, I would have booked them all at 40% to reflect the future tax rate. But that was not the case. We're just saying that it's 35% for year 2 and up. For section B, it's about carry backward and carry forwards. So Lily's Inc. reports the following pre-tax incomes and losses for both reporting purposes and tax purposes. They give us our accounting income, depreciation in CCA, and then our tax rate. Assume all changes to future tax rates were enacted on January 1st, 2020, and that Lily's reports under the ASPE future deferred income taxes method. Okay, I'm going to use deferred tax again. Just so you know, for future income tax, instead of having deferred tax liability, you would have future income tax liability. So it's just a little bit longer to write. So that's why I'm not using it. But same, you're going to have a liability same time that you have a liability under the deferred income tax method. So required, we're going to do the journal entries for each of the years 2020 to 2022 to record income tax. Assume that the loss is first carried back, and that at the end of 2021, the loss carry forward benefits are judged more likely than not to be realized in the future. And then using the assumption in part A, prepare the income tax section of the 2021 and 2022 income statements, beginning with the line income loss before income tax. And then we'll do C and D when we're done with that. So first I'm going to find my taxable income because they're giving us all the info to find it. So I'm going to have my 2020, 2021, 2022. And then I have my actual income. We're going to assume that it's before tax, but normally it is for small problems like that. So it's 600,000 minus 1.3 million, 375, and then 119,000. Then I have my depreciation accounting. So I want to remove its effect. So I want to add it back to my accounting income, and it's 60,000 every year. And then I have my CCA, which I want to reflect. I want to deduct to get to my taxable income. So I'm going to remove 110,000. I'm going to remove 110,000. I'm going to remove 60,000. So then I get to my taxable income, which is 550,000 for year one, a loss of 1.4 million for year two, and a taxable income of 119 for year three. My tax rate for each year is 30%, 35%, and 35%. And that gives me a current tax expense for year one and two, well, for 2020 and 2022, because in 2021, I'm not going to be paying any tax because I have a loss. So for 2020, it's 550,000 times 30%. Then year three, it is 119 times 30%, 35%, sorry. So that's my little reconciliation. Then I'm going to do my journal entries for 2020. So I want to record my current tax expense. And I also want to record my deferred tax expense. I'm going to do them both in the same journal entry. I know I went a little bit too fast, but I know I'm going to have a liability, a deferred tax liability, because if I sum my two together, it's negative, paying less taxes this year, more taxes in the future. So I'm going to have my income tax payable, and I'm going to have my DTL. My current tax expense is what we calculated here. My income tax payable is the same amount. And my DTL is going to be the sum of my depreciation in CCA times, times the future tax rate. Because here they say that all changes to future tax rates were enacted on January 1st, 2020. So at the end of 2020, they already know that next year their tax rate is going to be 35%. So I'm going to record it right ahead at 35%. That's my journal entry for 2021. For 2020, for 2020. For 2021, what happens here is I'm going to want to record my temporary difference here, but I'm also going to want to apply my carry backwards to my income of 2020. And then if I have any left over, I want to reflect it in my statements. for future years when I'm gonna have a taxable income. So first, to record my deferred tax expense or liability, I'm gonna check if my sum of depreciation and CCA is positive and negative. Here it's negative, so I'm gonna be recording a liability again. So it's gonna be a deferred tax expense to DCL for the same amount as 2020, because I don't think the amount changed. So I'm gonna do the sum of these two times my future tax rate, so 35%. Then I wanna get back the amount of taxes that I paid last year. What you want to check is my loss greater than my income in the last year? It is in this case. So I'm going to be able to get back all the taxes I've paid. If my loss was like 500,000 instead of 550,000, then you would prorate the amount of taxes you paid last year to only get like 500,000 worth of taxes back. So what you're going to do here is that you're going to book a receivable because you're going to receive the money from the government. The amount that you're going to receive is the full amount of expense that you had last year. And then the other leg of the transaction is current tax benefits. So normally you see you book a tax expense. Well, now we're going to book a benefit, and it is going to increase your income for the year in your statement. And then you want to check, do I have any leftover loss that I can carry forward? In this case, yes, because my loss was greater than my income. So I can carry forward the 1.4 minus the 550,000. I can carry forward $875,000 of loss to future years. Also important to note is that in the question here, they said that they judge that it's more likely than not to be realized in the future. So that means that they think that they can use 100% of the loss in the future against their taxable income. So I can book 100% of that amount in my financial statements. So what I'm going to do here is since your loss is going to make it so you're paying less taxes in the future because you're applying, again, your taxable income, so you're reducing the amount of taxes you're going to be paying, it's an asset. So you're going to book a DTA, and you're also going to book a deferred tax benefit. So it's the same transaction as what we did earlier. And the amount that you're going to book is the amount of carry forward that you have left times your future tax rate. If your tax rate changes in like 7 years, but you still have the balance available of carry forward, you're going to want to reflect it on your balance. That's it for 2021. For 2022, you're first going to want to book your temporary differences. But here, if you look, your depreciation is equal to your CCA, so you have no temporary difference, so you're not going to be booking anything. And then we want to book my carry forward that I'm going to apply against the tax that I'm supposed to pay for this year. So since I'm not going to be paying any taxes this year, because my amount that I'm carrying forward from last year is greater than the amount of taxes I'm going to be paying, all I'm going to be booking is a reduction in my DTA. So I'm reducing my carry forward by the amount of taxes I should have paid this year if I didn't have any carry forward. So now my carry forward balance available is my 875 of my loss minus my income for 2022. So I still have, like in the future, I can still apply my carry forward against $756,000 of income. I don't have to book any entries here because we already booked our carry forward here, and then we're reducing it here so that we're done with journal entries for these 3 years. Then they're asking us to do our statements, income statement for 2021 and 2022. So I'm going to start with income before income tax. So my income before income tax for 2021 was my minus, whoops, you have to look at your accounting income. So it's a minus, yeah. Let me just put the income and then I'll come back to that journal entry. So my income before income tax, you have to look at your accounting income before tax. So I'm putting my minus 1.3 million. And in 2022, I'm putting my 119,000. Pause for the income statement. For my journal entry here, what I did is I checked, one, I have my carry forward that I can apply against any taxes that I have to pay for the next future 20 years. In 2022, since I had taxes to pay, I applied that carry forward balance to the taxes that I was going to pay if I didn't have any carry forward balance. So because of my carry forward and because I have more amount of loss than income for the year 2022, I'm able to not pay any taxes in 2022. So you're not paying anything to the government because you had the loss in the previous year and your loss is greater than the income you have for this year. So you're not paying any taxes. And what you're going to do is you're just going to reduce your assets by the amount of taxes you would have paid if there was no carry forward provision. And then here, all I did is I calculated how much do I have left of my carry forward balance for future years after I applied my reduction for 2022. No problem. So if I go back to my income statement, your income before income taxes is always your accounting income. And then you want to put your current tax expense and you want to put your future, well, I guess it's different. So here you have to be careful. Remember, expense reduces your income, benefit increases your income. So in 2021, I had a deferred tax expense here. So this reduces my income, but I also have, oh, sorry, wrong line. So here I have a deferred tax expense. No, for my current tax expense, I have a current tax benefit. So benefit increases your income. So I'm going to put it as a positive. And then for my deferred tax expense, I had an expense. So this reduces my income. So I'm going to put it as a negative. So then I get my net income after taxes, and that's going to be the sum of all of these together. Oh, I'm missing an account. In my deferred, I also have my deferred tax benefit, and it's a benefit, so I'm going to add it to it. So yeah, so you're booking a benefit as a plus in your income statement and an expense as a minus. Here I'm looking at these three transactions to do my income statement. For 2022, for current, I don't have anything. And then here I'm gonna have a deferred tax expense of 41,650. So that gives, oops. So it's an expense, so you have to put it as a negative. That gives me a net income of $77,350. So see, they're still taking into consideration the amount of taxes that you should have paid. So they're still reducing your income for the year. It's just that instead of paying it, you're just reducing your provision that you set up in previous years. And that's it for chapter 18. I think we can take another break of 10 minutes, and then we'll do chapter 19 and 20 in one go. They're less long in the sense that the theory is like, you don't really need to know that much theory to do the problems. So Carmine, I guess it's only you that's left. Do you want to take a break, or do you want to go straight into the problem? Or maybe you're already on break. All right. Yeah, no worries. Do you prefer if we do the problems now? Or we go on break for 10 minutes and then we come back? Okay, then no worries. That's totally fine. I'll take my 10-minute break, and then I'll talk to myself for a little bit. So no worries. Thank you for coming. No problem. For chapter 19, what we're going to be really covering, is it working? Okay, so for chapter 19, it is the easiest chapter of the last 3 chapters. So this chapter, just really get comfortable with working with the worksheet. It should be provided during your exam. So if you don't know what I'm talking about a worksheet, is this. So get comfortable into plugging your amounts here, and get comfortable in to like know how to calculate each of these. That's like the key to this chapter. You don't really, like, if you're worried because you don't really know what a current service cost is, it's not the end of the world. You're not being tested on if you know what it is. You're more tested on, are you able to calculate your obligation at the end of the year? Are you able to calculate your planned asset at the end of the year? Do you know how to get to your entries at the end of the year? So if I do a little bit of theory, a pension plan is when you're working, and when you're working, for example, in a big company, you receive benefits. And one of the benefits is the pension plan. So that means that the company is either contributing to the pension plan or is assuring you a full amount at the end of your career when you retire. So when you retire, you get all the amounts that the company contributed into your pension plan, and you also, or you get like the full amount that they set up for you. There's 2 types. There's the defined contribution plan and the defined benefit plan. The defined contribution plan is one that is a little bit more popular because the company is not the one at risk. So what I mean by that is that for defined contribution plan is that the employer is going to tell you, I'm putting $1,000 every pay into your pension plan, and then that $1,000 you get to decide how you're going to invest it, and you're the one in charge if you're the one responsible if you invested in all the amount, and the amount that you get goes down, then it's your loss. You're the one that like didn't like manage it properly. If it's so the risk is on the individual, on the employee, it's not on the company. If it's a defined benefit plan, the company is going to say, okay, look, when you retire, I'm giving you $250,000 for sure. So it is up to the company to make sure that throughout the employee's like life at the company, if you want, like throughout the time that the employee works at the company. They set aside enough money and they take into consideration the changes in market, so that they have at the end of the time when the employee retires, enough money to pay the benefit plan. So if like I retire at 65, the company promised me 250,000, but they made bad investing decision and they only have 100,000, they have to pay out of pocket the 150,000 that's missing for my benefit plan. I'm not the one responsible for that. They are. As you might imagine, defined benefit plan are a little bit rarer now. My mom and my brother actually work for government entities, work for government entities, and they have defined benefit plan. But I personally, I've worked at a few companies, and the plans that I had were defined contribution plan each time. So I get like a sheet when I start my employment saying like, okay, we're going to contribute a percentage of your pay into an account, choose into which account you want us to put the money, and I'm responsible to decide, and then I can also put a contribution myself each pay. But my brother, for example, he knows that at the end of his employment, when he's going to be retired, he's going to get like the salary of like the 5 best years he worked, and normally like of the 5 highest salary he worked throughout all his employment, and normally it's the last 5 years, right, that you're going to get the higher salary. So he doesn't know how much like for sure, but he knows it's going to be like an average or the sum, I don't remember exactly, of his 5 best salary years. So he's not the one responsible with coming up with that money or doing the investing for that. His employer is. So I kind of talked about it, all of that. So what we're going to be accounting for is defined benefit plan, because the company, throughout the time that the employee works there, the company has to account each year for the portion of the defined benefit plan that the employee earned for that year. So let's say I worked there for 20 years and I'm entitled for 100,000 at the end of the years. My first year of employment, the company already has to take into account that in 20 years, I'm going to receive 100,000. So they start accounting for it as soon as you enter into the plan. This creates on the balance sheet a plan asset, which is all the, if you want, the cash investment that they're putting into the plan asset, into the market. And it also creates an obligation. So that's the payable obligation that the company owes me in 20 years. That obligation is going to, of course, be present valued. So there's that, but you're not going to have to do like the entries for like when an employee first enters into the contract. What you're going to be doing is like the overall journal entry for all the employees and all the plan for all the company. So like I said, you're going to be booking an obligation. That obligation goes into your liabilities on the balance sheet. And how it's calculating is you take your balance from last year, you're adding your current service costs, you're adding your past service costs, you're adding your interest costs, you're adding or subtracting your actual gain, and you're removing your benefits paid, and that gives you your ending. So past service costs happens when either there's a new plan or the current plan is amended. And this is, so let's say I've been working at the company for 5 years. They had no pension plan. And then after 5 years, the company decides to set up a defined benefit plan for all their employees. They recognize that I've worked there for 5 years already. So they're like, okay, we're going to recognize your 5 years and we're going to take some amount of money for those 5 years and we're going to put them in our obligation. So that's going to be past service costs. The amount for my 6 years and up is going to be current service costs. How you find your past service costs, it's usually given, but sometimes they want to be tricky and they don't give it to you. Is going to be your net interest cost. So this is another, it's your interest cost here, divided by the percentage, the market rate or the interest rate that they use, minus your beginning balance of the obligation. That goes into your obligation, and the other like leg of your entry is an expense. So it is expense under both IFP and IFRS. Your interest cost, since I told you that your obligation is the PV, you're going to want to record interest to increase it every year. So how you're going to do it is your beginning balance of your obligation plus past service costs times your interest rate. If normally you either have your interest cost given or your past service cost given, so you're not missing anything for your calculation. Actual gain or loss. So it's hard to like evaluate. There's so much that goes into like evaluating like how much I'm gonna owe someone in 20 years. Like how much should I put now so I have the right amount in 20 years. It's not accountants that do all this calculation. It's actual, I don't know how it's actuarials. I think that's the profession, but an actuaire, for those who speak French, they're the one that's doing all the calculations. So that amount is always going to be given. And everything is expense under ASPE, but your gains and losses are in OCI under IFRS, and they're in OCIs in IFRS because they're unrealized gains and losses because you haven't like paid it out yet. And also it cannot be an OCI for ASPE because you have no OCI. Your benefits paid to retirees is the amount of money that you actually paid during the year for the people that retired. So that's going to reduce both your obligation and your plan assets. And then we get to plan assets. So this is a asset account in your balance sheet. How you calculate it is you're going to have your beginning balance. You're going to have your expected return on assets, your employer contribution, your employee contribution, and then your actual loss and gain on investment minus your benefits paid. So your expected return on assets, I guess I should define plan assets. So normally companies takes all the money that they're contributing and they're putting it in a trust. And then that trust is separate from the employer company, but that trust is going to be an asset on your balance sheet. It's that the trust can only be used to settle your defined plan obligation. It's mainly cash and investments in debt and equity securities, so investment in shares and stuff like that. Your expected return on assets is how much do you expect to gain from your assets for the year. So that's going to be your percentage, your current market rate times your beginning plan assets. So this is an expectation. You have your employer and employee contribution. So that's how much money that the employer put into the plan assets for the years, and employee, it's how much the employee put into it for the year. Then you have your actual loss on investments. So we had here the expectation, and here we have what actually happened. So it's the difference between what has actually occurred and the previous actuarial assumption about what would occur. If your expected here is less than your actual, it's going to be a loss. And if your expected is greater than your actual, it's a gain. Again, all your gains and losses under SPR expense, and their
under IFRS, they're put in OCI. Then that gives us your final account is your net benefits asset liability. So this is basically the difference between your obligation and your assets. So it's like your balance account between the two. If you have a difference between the two, it goes in there. So if it is underfunded, that means you have a greater liability than planned assets. So you didn't put enough in there. So you're gonna have a deficit. And then if your obligation is smaller than your planned asset, then it's overfunded. So you put too much, so it's going to be a surplus. And then you have your worksheet here that we're going to be using to solve the problems. So here, first of all, if it's a positive amount, it's going to be a debit. And if it's a negative amount, it's going to be a credit. So here, you see your balance of your obligation is all in negatives. Because it's an obligation, it's a liability, it's a credit. And your planned asset, it's a positive. Yeah, so this should be given at the exam. At the end, when you add all the elements I talked to you about, you're going to get your journal entries. You're going to have an expense entry, you're going to have a funding entry, and that's it. So you're going to have your pension expense, pension liability, net pension asset, cash, and then OCI if you're under IFRS. For the questions, I only put one question because they're always kind of the same. Another type of question that is really popular is you fill in the blank. You already have a worksheet and then you fill in the blank. So you are elated to have landed the summer job of your dream as an accounting intern with Hire and Fire Corporation, a national executive recruitment firm. Your supervisor and mentor, Real Tears, greets you with a tough assignment on your first day of work. She handed over a sheet containing some hastily scribbled notes and a comment. I wish to start you off with something light and easy. Here are some notes on our pension fund operation for 2017. Could you please sort this out by the end of the day? And yes, did I tell you our firm is currently with ASPE, but considering a switch to IFRS in 2021. Then they're giving us a note containing the following information. Your beginning projected benefit obligation is of $568,000. The plan is underfunded by 60% of this amount, and the regulatory agencies consider this to be quite heavily underfunded. Prior service costs were recorded on January 1st, 2017 to be determined by the intern. The current service costs for 2017 amounted to $140,000. The plan uses an interest rate of 8%. We recorded an interest expense of $52,240 for 2017. Our investments of the plan assets did very poorly, earning only $13,178 on our plan assets in 2017. The corporate pension committee overseeing the plan operations had decided to fund an amount of $35,000 in addition to our normal annual contribution, which we make as per our corporate policy. The company normally contributes 5% of the PPO carried forward from 2016, plus 50% of the current service costs and 60% of any past service costs incurred during the year. Employees funded $20,000 to the plan as it is a contributory pension plan. Benefits payments for the year were $74,000, and it was determined by the firm's actuaries that the ending balance of the plan assets appropriately reflected their fair market value. The projected benefit obligation was revalued at the end of the year and should reflect a $50,000 reduction in the BPO otherwise determined. So they required, a little while later, while you were still sorting things out, she arrived at your solid oak wood desk and gave you some more specific instructions. Give me a summary of the activities, showing them on a worksheet per ASPE. And oh yes, prepare the entries that are required for us to record all these activities. I wonder whether pension expense could have been any difference if we had been with IFRS. What would have been the amount? Please give me some brief details on how you came up with that number. So I have my worksheet here, and I'm gonna fill it out with the information that was given to me in the problem. So I'm gonna go bullet point by bullet point and sort it out. So first, they're telling us that the beginning projected benefit obligation is of 568,000. So I'm gonna be putting it here as my balance on January 1st. And since my obligation is a liability, I'm gonna put it as a negative. Then they're telling us that the plan is underfunded by 60% of this amount. So that means that here, this here is only 40% of the amount here. It's underfunded. So I have less assets than obligation. So what I'm going to do is I'm going to do minus 0.6 times this amount. And that gives me 340,000. So my net benefits, my balance account here is my net benefits asset liability. And what it is, it's basically just going to be a sum of the two here. So here it is a liability of 227,000. Then I can move on to my next bullet point. Prior service costs were recorded on January 1st, 2017. So we do have service costs, but we don't know what they are. If you remember from the tutorial, from the PowerPoint, we can find our past service costs using our net interest costs. So I'm gonna go and check if I have that given to me. So it says in the next bullet point that the plan uses an interest rate of 8% and that we recorded an interest expense of 52,240 for 2017. So I'm gonna put that number here. And now here I can find out what my past service cost here. So I'm gonna do, I'm gonna isolate basically my past service cost. So it's gonna be my interest cost divided by my market rate, well, interest rate of 8%, minus my obligation. So it's 85,000. So again, what I did is I took my little formula here and I just isolated my past service costs to get to my 85,000. So my calculation is 52,240 divided by 8%, minus my obligation, and it's really like minus like in absolute values, like you're doing minus 568,000. Then if I go back to my bullet point number 2, it says that the current service costs for 2017 amounted to 140,000. So I'm going to put that here. And important to note that all of these amounts go into my obligation. So I have to add them all here. They said that our investment of the plan asset did very poorly, earning only 13,178 on our plan assets in 2017. So my expected return, we are going to have to calculate it. We know my actual return was 13,000. So the difference between my expected and my actual is going to be booked in my actual loss on investment. Also, because I'm using ASPE right now, my loss is going to be recorded in my expense. So my expected return on investment is my rate of 8% times my beginning plan asset balance. No. Oops, okay. So here I switched it up. It's underfunded by 60%. So here it should be 40% and not. So here, since underfunded by 60%, that means that my plan asset balance is 40% of my ABO. Okay, so just a little like percentage error here. That means that my expected return on asset is 18,000. I'm going to be putting it as a negative here because this needs to increase my plan asset. So I need it to be a debit in my plan asset column. So I record my expected return as a credit. Then I know that my actual return was 13,178. So it was lower than what I expected. So I'm going to be putting 18,000 minus the 13,178. So that means that my difference between my actual return and my expected return was almost $5,000, and it was lower than I expected, so I need to reduce it. So if I sum these two amounts together, I see that my actual return was 13,178. So you want always that these two reflect the actual return in your plan assets. So here I'm going to put it as the reverse of what I got here. Then they say that the corporate pension committee overseeing the plan operations had decided to fund an amount of 35,000 in addition to our normal annual contribution, which we make as per corporate policy. The company normally contributes 5% of the BPO carry forward from 2016, plus 50% of the current service costs and 60% of any past service costs incurred during the year. So that is how much cash did the company actually contribute to the plan. So it's 35,000 plus 5% of the BPO carried forward from 2016. So I'm going to do 5% of my 568,000 plus 50% of my current service costs plus 60% of my past service costs. So that gives me the contributed cash 140,000. And that's gonna be a negative here because they're gonna credit their cash, right? They're paying cash. And they're increasing their plan asset by the same amount. So here I want to increase it by 184,000. Then they say that the employee funded 20,000 to the plan as it is a contributory pension plan. So that's going to come and reduce my expense and increase my plan asset. And then they say that the benefits payments for the years were 74,000. So that means that I'm reducing my obligation and I'm reducing my plan assets. Then they say that it was determined by the firm actuaries that the ending balance of the plan asset appropriately reflected their fair market value. So here I don't have to take any do any changes to my ending balance. But they said that the projected benefit obligations was reevaluated at the end of the year. It should reflect a 50,000 reduction in the BPO, otherwise determined. So I want to reduce my ABO by $50,000. So I'm going to debit it. And that debit is going to create a gain in my income statement. So now I can calculate all my ending balances for all my sections. I should do this. And I can do my journal entries. I tried to check if you did everything right. Oh, I'm going to do this at the end. So my journal entries, I'm going to be doing, well, I shouldn't have done that. Do it this way. Okay, so first my expense entry, it goes in as a credit in my net benefits asset liability. Then for my funding entry, it's going to be minus cash, and that's going to increase my net benefits. So that means that my net benefits asset liability balance is at the end of the year. It's 350,462 as a credit. And then my obligation is a credit of 7,221,000, and then my current assets should be a debit of 370,078. A way to check if you got the right amount is if you sum these two together, they should give you the same amount as your net benefits. So it does, so I'm good. The journal entries that you're going to do, you're going to have your pension expense. That goes to your accrued net benefits, assets, liability. So that's going to be your 194. And then you're going to have your funding entry, which is basically just this account as a debit, and then cash account for the amount of cash that you paid. So this was for A and B, and then they're asking you for C, what would have been the pension expense if it was with IFRS? So under IFRS, your actual gain and losses are put into OCI instead of your income statement. So that's going to be the difference between the two. So your pension expense under ACCO was 194. We're going to want to remove our actual loss and expense on investments, and we're going to want to remove our actual loss on ABO. So you're doing an expense, right? So you're looking at the debit side. So if it is a credit, you're actually going to want to increase your expense by that amount. So here I want to increase it by 50,000, and here I want to reduce it by 4,000. So my pension expense under IFRS is 239,064. For chapter 20 leases, it's another tricky chapter, and it's also that the standard changed quite recently. I think it was in 2019, beginning of 2019. So a lot of past finals that we have that are available are not reflecting of the new standard. So you have a little bit less problems to practice on, especially if they didn't like give you any past finals from like 2020 till 2022. I don't remember about the book problems if they're telling of what is going to be on the final. If I remember, yes, they're good, but for this chapter, you're gonna see it's always kind of the same thing that you're doing. So even if you only have like 2 or 3 problems that you can practice on, if you understand them well, you shouldn't have any problems for your final. So what are leases? It's a contract between a lessor, someone that's renting an asset, and a lessee, someone that's getting an asset. And it gives the lessee, for a specific period of time, the right to use an asset that is owned by the lessor. So for example, like a common lease is for an apartment lease or a manufacturing lease. Let's say I'm a company and I want to rent a warehouse. Well, I'm going to enter into a lease with the owner of that warehouse and say, okay, I can use that warehouse for 20 years and I have to pay this much amount, but I can do whatever I want with that warehouse. I can do some changes to warehouse. I can paint it. I can install a bunch of things. Like that asset is as if it was mine. So the right to use the asset is provided in return for lease payments. So every year or every month, I'm going to have to pay, I don't know, 17,000 to the lessor in order to be able to use the warehouse. There's 2 types of lease. There's the capital/finance lease. It's called capital under ASPE and it's called finance under IFRS. But It's a lease that transfers substantially all of the benefits and risk of property ownership to the lessee. So that's what I was talking about the warehouse. So it's as if the asset was the lessee's. They can do whatever they want with them but in return, they have to pay the lessor, and they can only use it for a certain amount of time. The other type of lease is operating lease, and when the benefits and risk of ownerships are transferred from one party to the other. Your apartment lease, you're not owning the lease. It's not as if you're owning your apartment. Your lessor, so your I don't remember the word, but the person who owns the apartment to which you give your rent money every year, your landlord, they're the one that owns the apartment. So if you have, like, if your sink breaks, or if there's something that happens to your apartment that is like because the building is old or whatever, then it's your landlord that has to assume the risk and has to pay for it into the reparations. You need to determine if the lease is either a finance or operating lease for both the lessee and the lessor, because it could be a finance lease for the lessee and it could be an operating lease for the lessor. The criteria for finance lease under IFRS is that all leases are finance lease. So they're all capitalized and they're all like as if you own the asset, except when the lessee elects. So they have to elect to make it a operating lease, and it is when it's a short-term lease, so it's a lease that is less than a year, or they have to make less than $5,000 minimum lease payments, because it's not a big amount. It's $5,000 US. For the lessee under ASCII, one or more of the criteria is met. Then if one or more of the criteria below is met, then they're going to capitalize the lease. So they're going to record an asset in their balance sheet. Oops. So the first criteria is, do the lessee have a bargain purchase option? So can they, at the end of the lease, can they buy the asset at the lower price? Or do they keep ownership at the end of the lease of the asset? Second one is the lease term at least 75% of the useful life? And third is the present value of the minimum lease payment at least 90% of the fair value of the asset? Here's how to calculate the present value of the minimum lease payment. For finance lease for the lessor under IFRS, the same thing. And under ASPE, it's the same as the three criteria, and you need also to fulfill the following two. So you need to be able to predict the payments, and you have no uncertainties regarding future costs to be incurred. So these will be given word for word in a problem if there's any. So if they don't fulfill any of these criteria, then it would be a operating lease, and everything in an operating lease passes through the income statement. So they will book rent revenue when they receive the revenue, and they will book rent expense when they pay their minimum lease payment. For a lessor, you also want to look at, if it's a capital lease, you want to look at, is this a sales type or direct financing lease? Sales type is this if the cost base for the leased out item is lower than its fair market value, then you're going to have a profit, because your fair market value is higher than your cost. So that difference is a profit. And so you're going to be recognizing a cost and inventory reduction. So it's as if like you're selling your asset. If it's a direct financing lease, they're going to have no profit, and they're in the lease payment, they're going to recognize that part of the payment is interest income. So you're going to exchange a non-financial asset for a financial asset. So The difference between the two is one is like as if you're selling it, if you will, and the other one is like an exchange of assets. Okay. So for question 4, on January 1st, 2008, Canadair Jets Inc. enters into a 4-year non-cancelable lease agreement to lease a original jet plane to Canuck Airlines, with payments required at the end of each year. The following information relates to this agreement. So we know the cost of the airplane, we know its fair market value, and we know the useful life. We know that there's an executory cost of $132,000 related to lease plane that will be initially paid by Canadair Jets and collected from Canuck Airlines. Annual year-end lease payments will allow Canadair Jets to earn an 8% return on its investment. When the plane will revert to Canadair Jets at the end of the 4-year period, it's estimated to carry a fair market value of $4 million, though there's no guarantee from Canuck regarding this value. IFRS applies to Canadair Jets and ASPE to Canuck Airlines. Both companies have December 31st year ending. So for requirement 1, for section A, indicate the type of lease Canadair Jets has entered into. Support your conclusion by applying the appropriate criteria for classification. Clearly state the criteria specified under IFRS and indicate which criteria applies. Determine the total annual installment for Canadair Jets seeks to receive from the lease contract. Prepare the lease-related journal entries for January 1st, 2008 and December 31st, 2009. And assume that the fair market value of the plane returned by Canuck Airlines on December 31st, 2011 is of $2.4 million, and the journal entries. So first, we're going to set, so the lessor here is Canadair Jets. And they're the lessor because the asset system is theirs and they're leasing it to Canuck Airlines. So they're not going to have the asset anymore, and it's going to be Canuck that's going to be using it for the time of the contract. So first, section A. First, they're asking us to tell what kind of lease it is. So Canadair, they're first the lessor, and they're using IFRS. So the criteria are 1, is it a short-term lease? So less than 1 year. And 2, is it are the lease payments less than 5K USD? So the short-term lease, well, the time of the lease is 4 years. So 4 years, so no. And the lease payments are of, we're gonna find them. So they're not telling us here how many dollars they're paying each period to gain their rights to the assets. So we're gonna have to find out what are our lease payments. To do it, we're just gonna find the value of your payments because we have your future value and we have our present value. So we know that the contract is for 4 years. We know that the interest rate is 8%. We know that our future value is going to be $4 million. Here, it's an unguaranteed residual value, right? So it's unguaranteed. But since the lessor, you still include it. You would also include if it's a guaranteed residual value or if there's a bargain purchase option. So basically, at the end of the lease, how much would the asset be worth? Then that's what you put as your future value. Payment is what we're trying to find, and the present value right now, the fair market value of the asset is 20 million. So then I can calculate my payment. So my rate is 8%. My number of periods is 4. My present value is 20 million, 4 million. And then it's at the end of the period. So I have minimum lease payments of 5 million. So it's a lot higher than our 5 million USD. So no. So it will be a finance lease. Because it's a finance lease, we have to find if it's a sales type or direct financing type. So we're gonna have to find, is there a profit that I'm making? So we're taking our book value of our asset and we're taking the fair market value of the asset. And is there a difference between the two? The book value of the asset is 17.6 million. My fair market value is 20 million. So that means that there's a profit of 2.4 million. So it's a sales type. So that means that when we're going to be setting up our first journal entry, what we're going to want to do is record a decrease in inventory and our COGS. That was A. B, determine the total annual installment which Canadair Jet seeks to receive from the lease contract. So we already calculated that our minimum lease payment was 5.1 million here. But they also say that the executory costs are going to be included into payments by Canada Airlines. So we're going to add that to it. We're not adding it to our lease calculation here before because it's not part of the lease. Let's say it's more like an extra cost that Canada is covering. It's related to the asset, but it's not. They're not forced to pay it. They could not pay it. And then C, prepare the journal entries for January 1st, 2008 and December 31st, 2009. So on January 1st, 2008, it's when the contract is entered into. So what they're going to want to record, you're going to have the lease payment receivable. So how much money they're supposed to receive. You're going to have your COGS. So that's your book value of your asset. You're going to have your sales amount. You're going to have your inventory amount. And you're going to have your unearned interest income. So the lease payment receivable is your minimum lease payment times the number of period plus any unguaranteed residual value, guaranteed residual value, or bargain purchase option. So here, my lease payment receivable would be my payment of 5,150,000 times 4 plus my 4 million. My COGS is the book value of my asset, same as my inventory here. So it's as if my airplane that I'm renting, I was selling it. Then for my sales amount, it's the present value of my payments plus any guaranteed value or BPO minus the present value of my unguaranteed residual value. So here we already have we already know the present value of my payments is 20 million. We found it using this. We need to find the present value of my unguaranteed residual value. So it's my 4 million. So my N is 4. My interest is 8%. My future value is 4 million. That means that my present value is my rate, my number of period, future value, and it's at the end of the period. Oops, payment, there's no payment, 0. So that gives me a present value of 2.9 million. So I'm going to do my present value of my payments, which is 20 million, minus the present value of my unguaranteed residual value. So that gives me a sales amount of 17 million. My unearned interest expense is a plug, or you can also find it using an amortization table. So we can do that. It is my debits minus my credits. So that gives me 7 million. Oops. Oh, I'm sorry. My COGS is not this. My COGS is my inventory amount minus the present value of my unguaranteed residual value. So it is this minus the 2.9 million. It's this because you're selling your cost of goods sold. So if there's a 4 million at the end, you didn't sell that 4 million, you only sell the 16 million. You want to find the present value of that. So here it's a plug. To find it, what you can do is an amortization table. So you're gonna have your date, your annual, well, your minimum lease payment. You're gonna have your interest expense. You're gonna have your reduction. And then you're gonna have your lease obligation. On January 1st, 2008, you have a lease obligation of 20 million. Your lease obligation is your fair market value of the asset. Then on December 31st, you're going to have your interest expense. So your minimum lease payment is the 5-year here. Your interest is the 8% times your previous book value. The reduction is going to be this minus this. So that gives me a lease obligation reduction of 16 million. So at December 31st, 2008, my balance of lease obligation on my balance sheet is going to be 16 million. Again, on December 31st, 2009, December 31st, 2010, December 31st, 2011, that's 4 years. Just going to copy this here. So at the end, I have my unguaranteed residual value as an obligation. And if I sum all my interests together, I'm getting the 4.6 million that I found here with my plug. So that's another way you can verify yourself. But since you only have 2 hours for your exam, I would just plug it and hope that you got the right amount. So that's my journal entry for January 1st. My journal entry, my journal entry for December 31st, 2009. So it's this line here that I have to look at. What I'm going to do, I'm sorry, my jaw is hurting. What I'm going to do, I'm going to use cash. I'm going to be receiving my minimum lease payment plus my executory cost. I'm going to reduce my lease payment receivable by my 5.1 million, and then I'm going to reduce my executory cost expense, if you want, by the 132,000. I also want to record some of my interest income. So I'm going to reduce my unearned income that I had set up on January 1st, 2008 by the interest here, the 1.315. And then I'm recording that as interest income. So that's it for 3. For requirement 4, it says that assume that the fair market value of the plane returned by Canuck Airlines on December 31st, 2011 is 2.4 million. Prepare the journal entry. So on December 1st, 2011, my fair market value of the asset is 2.4. I thought that my fair market at the end of the 4 years was going to be 4 million, right? So I'm going to record a loss on these of the difference between the two. So you gain back your assets. So it was an airplane. You have a loss on these. And then you're going to have your lease payment receivable. That's going to be reduced by 4 million. This is going to be your $2.450, and difference between the two is your loss. That's it for Canadair Jets. Then they're asking us for Canuck Airlines. Use the data given above in the common data section for Canuck Airlines only. Indicate the type of lease Canuck Airlines has entered into. Canuck Airlines is unaware of the interest used by Canadair Jets to establish the minimum lease payment. Determine the amount for which the lease will be recorded. Canuck Airlines has been paying an interest rate of 10% per annum for its operating loans. And I prepared the lease journal entries on the accounting books of Canuck Airlines on January 1st, 2008 and December 31st, 2008. So for Canuck, they're the lessee and they use ACCO. So they only have to look at the first 3 criteria. So do they have a burden purchase options, or do they keep ownership at the end? The answer is no. 2 is the lease term more than 75% of the useful life of the asset. So the useful life of the asset is of 5 years. And then my lease term is 4 years. So that means that it is 4 divided by 5. It's 80%. So this one is a yes. So because it's a yes, it's going to be a capital lease. So that means that they're going to have to record a asset on their balance sheet. We can also look at the third one because I think that's like the more complicated calculation. Is the present value of the minimum lease payment at least 90% of the fair market value of the asset? And that's the yes, because we're going to be using the fair market value of the asset as our base to calculate the present value of our payments. So that's the yes, it's 100%. If we already got the minimum lease payment amount that they will be paying every year, then we could calculate the present value of them. And that if there's a difference between the present value and the fair market of the asset, then we can look at it and see if it's at least 90%. So yes, so one of the criteria is fulfilled, so it's going to be a capital lease. Then B, we're going to have to determine the minimum lease payments. So I'm going to look at my N, my E, my future value, my present value, and then my payments. My N is my lease term is still 4 years. My interest rate. before we used the 8%, and the 8% was the Canadair's like own rate. Now Canada doesn't know Canadair rate and passes. They wouldn't know also what rate they use. So they're going to use their own interest rate, which is 10%. The future value is going to be 0 because it's unguaranteed residual value. So it's always 0. If it was guaranteed or there was a BPO, then you will put that amount there. The present value is so your present value is what we're trying to find here. And then your payment amount is going to be the same payment amount as you determined in with Canadair. So it's the $5.1 million. So now we can calculate the present value. So the rate is 10%. The number of periods 4. The payment is the 5.1 million. The future value is 0 and the type is end of the period. So that gives me a present value of 16 million. So C, we're going to find the journal entry for January 1st, 2008. So for January 1st, for the lessee, it's a lot easier than for the lessor. Just want to record the leased asset that they now gain. So your leased asset, so the airplane, is the present value of the here. And then your lease obligation is the same amount. If you want to do the little amortization table, you're going to have your date, your minimum lease payment, the interest, which is going to be 10%. You're going to have your reduction, and then you're going to have your lease obligation. So then first, 2008, I guess I can copy from here. Your lease obligation is of 60 million. December 1st, 2008, your minimum lease payment is of the 5.1 million. It's going to be the same for every year. Your interest is going to be 10% of your previous balance. And then reductions would be the difference between the two. So it's going to be the 16 minus the 2.5 million. So here we're the lessee, and it's unguaranteed residual value, so it's okay that it's 0. So then after that, they're asking us for the December 31st, 2008 journal entries. So now they have an asset, so they have to book their interest expense, they have to book their payment, they have to book the depreciation expense. So I'm going to do first the payments. So for the interest expense on December 31st, it's the 1.6 here. The lease obligations, the 3.5 here. The executory cost is 132,000. And the cash amount is the sum of all your debits here. Then your depreciation expense. And accurate depreciation each asset. So I'm just going to copy something here. If the amount was guaranteed, then your calculation would be the leased asset minus the guaranteed residual value divided by the lease life. If it was a bargain purchase, no, if they had a bargain purchase option, then it would be the, oops, I copied the same thing twice. Huh? Oops, control Z, control Z. It would be the leased assets, like your book value divided by the economic life. But here, since we're doing the BPO, we're just going to be doing the leased asset amount that we booked on January 1st divided by the contract, the lease term, divided by 4 years. And that's it for the journal entries. Then they're asking us in section C, use the data given above. Assume for this section only that the residual value for the return aircraft was guaranteed by Canuck Airlines. Assume the interest rates by Canadair Jets and by Canuck Airlines are 8% and 10% respectively. So we're going to want to find the minimum lease installment and the amounts at which the lease will be recorded on January 1st, 2008 for Canuck Airlines. So we have a guaranteed residual value. Our minimum lease payment is still going to be the same as what we found earlier. It's still going to be the 5.1 million because we included it here, right, for the lesser in our calculations. So that doesn't change. And then for part 9, we want to find the present value of our minimum lease payment, which we already found before. This is 16 million here. And we want to find the present value of our guaranteed residual value, which we already found. It was here, but here we used, an interest rate of 8%, and we're looking at the lessee now. So we want to use an interest rate of 10%. So that gives us a present value of 2.7 million. And then our leased asset is going to be the sum of the two. So it's going to be your present value of your minimum lease payment plus the guaranteed residual value. And that's it for the tutorial for the final review. So if you have any questions, feel free to message me on Facebook or post on the group. I'll be answering you as fast as I can. I do have a busy week next week, and your exam is closer than I was expecting. You can also post on the group so your peers can see it and also answer you a little bit quickly. And yeah, my best advice is in person and on paper. Practice doing your problems on paper so you're not like dependent on Excel when you're doing it, your exams. So you gain speed by writing it down. Thank you for this semester. I hope that you appreciate the tutorials. And yeah, like I said, message me if you have any questions.